My co-chair, Representative Dorset, would like to say a few words.
Good morning, Madam Chair. It's great to be here. Finally, we've had to reschedule this hearing now twice, so I certainly want to start by thanking everyone for their patience who has been signed up for our original 2 hearings. The first one, I think we fell subject to the new rules and the vagaries of the Zoom hearings, and we could not proceed that day, just so people understand, because of the technical difficulties and the fact that the room was booked later in the afternoon. So thank you for your patience. And then again on Tuesday, the snowstorm was probably not as bad as it could have been, but I think it was good to make sure people could stay off the roads that day. So we are here finally, and look forward to hearing from everybody this morning. Thank you, Madam Chair.
Thank you, Representative Doucette. Representative Delnicki, would you like to say a few words this morning?
Good morning, Madam Chair. And it's great that we're having finally this public hearing, because it's your opportunity to tell us what you think of the legislation that we're looking at here. So without further ado, I want to thank the chairs, and I want to thank the gods for allowing for good weather today and an internet that works. So again, thank you, and let the public hearing begin.
Thank you, sir. So our first person to testify is Commissioner Perez. Is he here? Okay. Yes. So Matthew, then you're going to be testifying in the Commissioner's behalf. All right.
Joining us remotely. Yeah.
Oh, and he is joining us
Yep.
remotely. Okay.
Yes.
All right. Thank you. Good morning,
Yes, sir.
Commissioner.
Good morning, Madam Chair. I will be testifying. Matt and I will both be testifying in different bills. I will be testifying on the elder care exploitation for seniors, and he'll be handling the rest of the bills for the most part. So I will start. Co-chairs Miller and Doucette, ranking members Bertel and Delnicki, and honorable members of the Banking Committee. My name is Jorge Perez, and I'm the Banking Commissioner for the state of Connecticut. Thank you for the opportunity to testify before you today in support of SB 1088 and Act concerning financial exploitation of seniors. In my opinion, this is one of the most critical, most important bills that we have introduced as an agency. As our population ages, fraud and exploitation of our elderly residents has also increased. Protective Services for the Elderly reports that nearly 25% of their cases involve financial exploitation. It is also one of the most underreported crimes, with only a fraction being reported to authorities below our sum or following our sum reporting statistics. Nationally, more than 1 in 10 elderly people in the U.S. fall victims to elder fraud, have fallen into victims of other fraud in the last year. Over 8.68 million incidents of elder fraud occur every year in total. Average loss per case is $20,015, calculated by averaging the mean reported loss from those organizations. And I emphasize those are the reported losses. And besides the financial losses, there is the emotional, self-esteem, I now have no money to go on vacation with my family. I may not be able to pay the mortgage. There's been some really, really heartbreaking stories beyond the monetary loss, the impact that the fraud has had on our seniors and others who are not seniors. In all 50 states, losses due to elder fraud total $113.7 billion each year. Deposits accounts were the most common product involved with elder fraud cases, 60%, followed by debit cards, 24%, and credit cards, 7%. And if people want the sources of those data points, Matt, contact Matt and he'll be able to provide it to you. In Connecticut, elder financial exploitation occurs at an estimated rate of 8,212 per every 100,000 seniors. In 2020, there were 3,094 cases of elder financial crimes as reported by the Internet Crime Complaint Center, known as IC3, which is a federal law enforcement agency dedicated to investigating internet crime with a total financial loss of $38,600,000. When adjusted for estimate that go unreported, this number's jumped for over 72,000 with its estimated cost of $907 million. I could go on detail on what the bill is trying to do, but in the spirit of time, I will stop in this moment by thanking the committee for this opportunity again to discuss what I think is one of the most critical issues going on in the financial world and in our state and country around protecting consumers.
Thank you,
Simple.
Commissioner. Matt, did you want to add something?
Sure. Thank you, Co-Chair Miller and Co-Chair Doucette, ranking members Berthel and Delnicki, honorable members of the committee. I'm here to testify in support of another agency bill, Senate Bill 1033, which is an act concerning various revisions to the banking statutes. This has several agency bill proposals within it. And I will try to be brief. There is written testimony that goes a little bit more in detail. Sections 1 through 4 of the bill make modifications to our small loan statute. Of particular importance is the incorporation of a definition for income share agreements. This is targeted to include private for-profit educational institutions who may offer income share agreements to student borrowers. That we're increasing the cap to 50,000. We think this will capture many student borrowers and it will cap the interest rate at 25%. Sections 5 through 6 of the bill would raise the limit of sales finance companies. So this right now, it's the limit stands at 50,000. We propose to increase that to 75,000. Basically, this is around the purchasing of automobiles. This will capture more consumers who are purchasing automobiles. The price of automobiles has gone up since the statute was originally drafted, more than 2 decades ago. So that would make them subject to the jurisdiction of the Department of Banking. We have a proposal in there about gap waiver funding. So at the time of the time you buy your car, you may be offered a gap waiver, which would basically, if anything happens, if you owe more than what the car is worth, this would cover that. Oftentimes people may cancel this policy. This would allow them to have a refund of whatever is left on the gap waiver. We think that's important. Let's see, I wanted to touch on 6752, our digital assets bill, which would allow us to adopt regulations around virtual currency. The department is working on that, and we are supportive of that initiative. I'm happy to answer any questions. There are a couple of other things I think in our 1033 bill, but in the interest of time, you may have questions for us. Thank you.
Are there any questions from the committee?
I will have, yes.
Representative Doucette.
Thank you, Madam Chair. Thank you, Commissioner. Thank you, Matt, for being here. A couple of questions on 1033, the concept of small loans. We've actually heard some testimony, I believe, or had some discussions about that proposal now with the expansion, perhaps encompassing more financial products or more lenders coming in under that statute. Can you explain for the benefit of the committee who the small loan statute is meant to capture in terms of lenders, and again speak to perhaps the expansion of that, whether or not it will encompass more lenders and more small loans?
Sure. It is targeted to incorporate more lenders, and like I had said previously, particularly like trade schools and other for-profit institutions. So generally what they would do is, instead of offering a loan, they would offer an income share agreement. Those income share agreements over time have an enormous effective APR associated with them. So these borrowers are, really getting their education at a very, very, very high cost. We see this particularly what is in coding schools is a particularly new and emerging thing where, you go and you learn a trade, you learn how to code. You may not, get a bachelor, but that is an industry that is less focused on, a degree and more focused on attaining a skill. It is also one that is a high rate of landing a job and a high rate of a good paying job. So what we see in instances like this is that they will offer these income share agreements, and because they're relatively high paying jobs, when you look at what they're paying back and what the agreement is, the effective APR goes into the multiple hundreds of percent, which, to be honest with you, is not particularly different than a payday loan. So what this bill, while it would cap it, extends the small loan from 15,000 to 50,000, which we think would grab a lot of these institutions. It would subject them to licensure through the department, which means that we would have the authority to go in and review records, make sure that they're operating in a financially sound way. It would offer more consumer protections for borrowers and allow us to really enforce those laws. We think that it also, in instances like this, companies rely on those high percentage rates to make money. If they can't make that money, we think it will curb that activity, and it may offer, and then these student borrowers may be able to go and go to a different product that's a little bit better for them in the long run financially.
Okay, but
Does
it's
that
not,
answer your question?
it's not, it's not exclusive to the income share agreement. So
No. So it
more
would be,
traditional student loans as well would be covered if they're below 50,000. Is that accurate?
yes, although it is not, I don't think we would see a lot of companies that would extend an unsecured $50,000 loan, without some sort of like collateral or anything, but it is possible under the law.
Okay, and how about the merchant cash advance product that we heard about at our last hearing, and is the subject of another bill? If those were below 50,000, would those be encompassed under the small loan statute?
If it's in the consumer finance space.
Okay,
Okay,
Okay.
so the
So-
department regulates consumer finance.
Right.
We don't regulate commercial transactions.
okay, that's a good distinction.
If I could add something, as you all know, because we send you a report on a yearly basis about student loan complaints and increase and so forth, we don't get a lot. And I don't know the reason why. It could be because there is not a lot of issues, or it could be other reasons. But this is one area where we've been getting a lot more increase and concerns from consumers because they don't fully understand the deal that they got into, or the disclosures are not the same as the disclosures for those loans we do regulate. So I think there is a great need for this, even though there has not been a large number of complaints yet.
Madam Chair, I did have one other question on the senior exploitation bill. And I thank you and everyone who's been involved in the drafting of that. It's like a lot of things been a multi-year process, and I think we've gotten to a very good place with it. Could you talk just a little bit about how that bill is intended to work? I know we're probably going to hear later from the elder law bar, who are going to speak about a few distinct issues. And particularly, I think there's the concept of the trusted contact person and how that comes into play. If you could speak to that in the bill.
Yeah, Mr. Chairman, I'll start and then I'll let Matt add. First of all, when I ended my testimony, I thought we were going to ask questions about this bill. And then as part of that, I was going to thank the coalition that we put together to get us here today, right? And a tremendous part of that coalition has been the Community Bankers Association, the Credit Union League, and really, really big advocates and supporters of this have been ARP. We have gotten a lot of feedback from some of your colleagues, including yourself. And we have met with the other lawyers recently. And my understanding is they'll be testifying later on today, supporting the bill. And we would acknowledge that we're still trying to work slightly on clarifying one particular issue, in particular around powers of attorney. But because our coalition is so big, I need to go back to everybody, make sure everybody understands what that is. So I do want to thank everybody who's made this possible. This was not something that we did uniquely by ourselves. The Department of Justice has also been involved in this, and in particular NASA, which is the National Association of America of Securities Advice of Securities people, who came out with the original law and has implemented it, and stockbrokers and financial advisors. Now, to answer your question specifically, this is a volunteer thing. The financial entities who choose to do this, and we're going to give also the national banks and the national credit unions and to choose to enter into it, will have to agree to a set of rules that we will come up with, including training, right? So some of those details still going to need to be worked out to the best of my understanding. And at this point, I'll turn it over to Matt, who can add more to it.
Sure. Thank you, Commissioner. So when we talk to your question, when we're talking about the trusted contact person, we are in discussions with the elder attorneys and with the department on whether or not that's going to be mandatory. Right now, it's an option for financial institutions and for broker dealers and investment advisors as whether or not they have to ask for a trusted contact. We're always sort of in the middle in trying to give parity to industries. And right now, under the federal FINRA rule, it says that broker dealers and investment advisors may make efforts to reach out and obtain the information for a trusted contact person. So when we originally conceived the bill, we were sort of wanting to give parity to industries on that. And so when we crafted this for the depository institution, we borrowed that language. We're currently in discussions, very fruitful discussions, by the way, as we move forward through the legislative process.
Okay, yeah, that's helpful because I did see that testimony, and I'm sure we'll have other conversations about it. But I think as you frame it, that makes sense to me. But again,
And
can
Mr. Chairman, on that topic also, I'm sorry, on that
Sorry, go
topic
ahead.
also, we have two other agencies that are involved in this process, right? The Elderly Service Care and the Department of Social Services. So we need to coordinate with them on whatever the final rules are going to be. So that's why we're not as specific as saying, yes, this is the way it's going to be 100%, right? So I want to give you assurance that this is not something the Department of Banking is going to do by itself. Whatever we do is going to be in collaboration with our partners, including my sister, my colleagues,
Okay, well, thank you. That is helpful to know. And thanks again for your work on this bill.
Thank you.
Madam Chair.
Thank you. Commissioner, I have a question regarding
Sure.
SB 1088. And first of all, I want to thank you and the partners for crafting this piece of legislation, because we all know that seniors are very vulnerable to exploitation. And so I want to thank you very much. My question is regarding the mandatory training. Can you describe what that's going to look like? The financial agent that takes some action, is required to, as the bill says, to participate in some type of mandatory training. Can either one of you describe what that mandatory training looks like and who's going to?
I'm going to give it Yes, I'm gonna give it the first shot. And then and Matt could add on to it. In order for them to get the safe haven, they will have to have a manual, which includes the training. It will have to be acceptable to us. And as far as I'm also concerned, with input from my other two colleagues, my other two commissioners, the other two commissioners that deal in this field, it will probably look a lot like what FINRA came up with for the securities world. But again, I need to collaborate with the different partners to make sure that what we come up with is practical. And that includes also, by the way, consumers, and that includes elderly people, and that includes the elder lawyers, and of course, AARP and so forth. So to be honest, we don't have a concrete answer to that at this moment. And Matt, can you please add to it? Or if we make more answer on that.
While the training isn't particularly defined, many banks and credit unions and investment advisors already employ some sort of training for their employees, and they can probably talk a little bit more specifically about that around this. However, the department does offer a senior safe training that we developed. So this training came out of the North American State Securities Administrators, called NASA, and it was called Senior Safe. It was developed out of Maine by the Securities Commissioner, Judith Shaw. And that was back in like 2015, 2016. Since then, we've developed a program that we actually, the department, we have staff that go into banks and credit unions. Some of our state chartered, like Chelsea Groton, I know has taken several of our trainings. And we have a staff person who goes in and trains them on what to look for financial exploitation of seniors, different red flags, like withdrawing large amounts of money that are unusual, right? Is there another person with the elder that is unfamiliar to the bank? Things that might raise red flags that, in this case, what we're under this bill, if they get this training, which, I think what the department offers would be one way that we could satisfy this training. The bank, credit union, or depository institution would be able to put a hold on the transaction so that they can then investigate it. And having that training to say, hey, this person, I've never seen this person, they want to withdraw $10,000, which is unusual activity. That might be, a sign for the financial agent to initiate a conversation with the elder, to try to elicit from them. And, oftentimes there may be signs of dementia or, other sort of mental incapacity that would signal to, the financial agent who's doing the transaction, say, hey, this maybe isn't the best thing. I think this warrants an investigation or something like that. So to the commissioner's point, training isn't fully fleshed out, but we have a significant start with the training that the department already provides.
And my point was that we're not experts in some of those fields, like dementia, for instance. So we will work with our colleagues at disability services and elder care and law enforcement who may have more expertise on that. So the point I'm trying to say is, we're not coming to the table saying, here's a set of training and there is no room for improvement. Obviously, since we will be taking the lead on this, whatever training it is, the focus has to be to protect consumers, but not to protect them so much that a reasonable transaction is not able to be done. So it's a very delicate balance that we're going to have. And like Matthew stated, we do have a head start on it, but there is not yet, because we need to make sure it's practical and it works for everybody. And there's too many people. I mean, there's a lot of partners here, and we're going to have to balance, everybody's need. But the one thing that I can assure you is that it appears that no matter who the partner is, everybody's committed to protecting seniors from fraud.
Thank you, Commissioner, and I appreciate that. So what's concerning though, Commissioner and Matt, is that you're making it mandatory and it's not flushed out yet. So I'm hoping during the legislative process that it
Yes,
is
yes,
flushed
that,
out, right? There is.
we are
you
committed to working
describe
with
what
our
that
partners.
looks like,
Yes.
whether banks have, financial institutions have to submit their policy or they have to be a part of your program. But I think that's something that needs to, be addressed in the bill as you go through the legislative process. Thank you. Are there any other questions from the committee? Yes, Representative Delnicki.
Thank you, Madam Chair. I want to ask the banking department's opinion on 6752, the digital assets bill. What are your thoughts on that?
Commissioner, you want me to take a stab
Yeah,
at
go
that?
ahead. Go ahead.
Okay.
Go ahead.
So, where to begin? I guess
at
I'll
the
start with,
beginning.
I guess I'll start with FTX, the collapse of the cryptocurrency exchange FTX. People lost, a whole bunch of money. This is an issue that the department has been looking at and studying for a couple of years now. There's been hesitancy at the federal level in implementing strong regulations around virtual currency and digital assets. Our counterparts in New York probably have the strongest consumer protections and regulations around digital assets. They have really become quite a model for both other states and the Fed. So, the Federal Reserve, the FDIC, and other banking regulators are all looking at what New York is doing. And happy to report that we have an excellent relationship with our counterparts in New York. We see them quite a bit on a regular basis. And we've begun developing some rules and regulations around that. And we thought to come to the committee to say, hey, we may not have these ready for a legislative session, but it would be great to go through the regulatory process in adopting them so that we can do it when we're ready. So that's kind of the purpose behind the bill. And, we realize that this is a serious and growing problem. People are losing money. They're being scammed. We're happy to sort of take the bull by the horns and face this problem head on and adopting that. So
If I could also add something, I mean, there is, in my opinion, I think the statutes would allow the department to come up with regulations. But the lawyers claim that it's not as clear as I think it is, and therefore we should get permission, make it clear through the legislative process. And there's several reasons for that. One, yes, there's a new tool. There's a lot of consumer fraud happening in this. There's a lot of confusion, but also the industry are asking for states and the federal government to give some guidance. They are actually asking for regulations because it allows them to be able to tell their investors and the consumers that there is someone looking over it and there's some rules that they have to follow versus, and it also would eliminate those who are the bad apples because, we will go after the bad apples and make sure they're licensed and they follow whatever regulations that we come up with, which by the way, would ultimately have to be approved by the legislators. Third, we have a great advantage in this field and in fintechs in the fact that we're the only state in New England and probably the only one or two states in the country. And I will argue we're the only one, but there's another state that does have something very similar to what we call an uninsured bank charter, which most cryptocurrency entities and fintechs would prefer to have than to be licensed as a money transmitter. The reason being is that once you get that, you do not have to re-register and get relicensed in most other states. Some states will still require it, but not all states. Plus, you're able to say you have a bank charter. And ultimately, it could get you if you meet the criteria, get your master account in the Federal Reserve, and it would subject you 100% to our examination and enforcement powers. And obviously, if you get a master account, it would also subject you to the Federal Reserve examinations and regulations. Hopefully that answers your question. But at the end of the day, no matter what we come out with, and we put together collaboration of people, including the ECD, we had a meeting with the new commissioner there. What we come up with, we have to get public hearings. Before we even propose a regulation, we would take feedback from the different sectors that get impacted by this: consumer, the vendors, the legislators, and so forth. And then we'll put up for a public hearing, and then ultimately we'll still have to come back to the legislature for final approval.
I certainly appreciate your answer, Commissioner. And the sooner the better. I mean, this is like the Wild West with what's going on there. And I think FTX brought it to a focal point and literally brought the issue to a boil as to what's going on here. And I have a tremendous amount of concern over it. And I'm value your opinion. Personally, I consider this on the first read as a good start. And I'm just wondering if that's how you see it.
Yes, every journey starts with the first step, right? The first step is to make it clear who has jurisdiction over it. I also want to acknowledge the co-chairman, Representative Doucette. He's also given us some feedback. He's met with Matt and our general counsel on this. And I hope we can continue that kind of dialogue in the process of developing this particular regulations. This is a priority for the department along with other care. And in the budget, we are getting some new staff, and the staff is going to be dedicated partially to the development of this new regulation. Increase enforcement in the CRA and the fair credit lending laws, and of course, in the development of the elder care training and policies. So this is a priority, and those are the three top priorities for the department. This year, this year and the next 2 years.
Well, thank you, Commissioner, and thank you, Matt, and thank you, Madam Chair.
Thank you, sir. Are there any other questions from the committee? Seeing none, thank you, Commissioner, and thank you, Matt, for joining us today. Oh, I'm sorry.
And thank you all.
Please say,
No.
sorry, Representative Paolillo.
Thank you, Madam Chair. I appreciate the opportunity. Thank you, Commissioner. Thank you, Matt, for being here. Also, I just wanted to follow up on a couple pieces, but regarding more 1088. But I wanted to just thank the Commissioner for your service and for your office and your department for dealing with constituent concerns so timely and being a resource for seniors and for everyone else. As we attempt to serve everyone together. So thank you for everything that you do. Wanted to follow up regarding the trusted contact discussion and a couple points that you had raised, but wanted to ask this pointed question. Our financial institutions right now, do some underneath your supervision, do they provide for a trusted contact currently to be listed on an account for a senior?
Matt, do you want to give a shot to that? 'Cause I think I know the
uh,
answer, but I want to make sure.
There is not. They do not. It's only the people who own the account. So joint account holders and everything. As to my knowledge, there is no provision that would allow for a bank or depository institution to reach out to a trusted contact who is not a joint owner on that account.
Okay.
But perhaps the CPA, when they come up, they can either confirm or deny what my deficiency in knowledge.
And our goal will be that we need to address that issue, right? Obviously, unless that the trusted contact is the person that the law enforcement thinks is committing the crime, right?
So I guess my question would go around looking at banks where they may offer other financial products, possibly mutual funds or annuities. We're dealing with some of those relationships, those companies, as Matt mentioned, under FINRA, would have that ability already. So you have accounts being established passively under a same bank, same roof, same umbrella, but one part of the house with products, financial products being offer that opportunity to list a trusted contact. But then on the other side, possibly your CD, your bank CD, or your bank account, savings account doesn't have that option. So certainly, I think it's important because people have that opportunity now as they bank with financial products to possibly do that with different banking relationships and different products being offered, but not there, certainly. Which leads me to the part with training, because there are current continuing education requirements in place for the folks that you supervise. Whether it be with products that are being offered, financial products. Is there an elder care requirement with continuing education as we speak right now that can possibly more be tailored to this conversation to look at where current fraud trends are going, given that there are requirements out there for folks that are licensed in the state with certain financial products as they're offering them to elders and to everyone else?
And it's my understanding that to this elders, there was a federal act passed several years ago that does require some basic training. In order to be for an institution or an entity to qualify for the safe harbor, that training is going to be much more in depth, and it's going to be much more specific. And again, it's going to have the input of my two other colleagues that who supervise an agency that deals with other people also. But Matt, you could add if I left something
Sure.
out, or if you want to expand, please add.
I guess I would start by emphasizing that, particularly in Section 1 of the bill, when we're talking about the securities industry to address Representative Paolillo's question, that most of that can already occur under the FINRA rule. What this legislation does would codify it into Connecticut statute and give some authority to the banking commissioner to receive complaints, investigate, it would give us investigatory power over what goes on for Connecticut residents. So yes, there is some of that's going on, as Representative said, on that side of the house. What this bill does is for the other side of the house, and the banking and depository institution, it gives parity, or at least that's what we're trying to do, is to give some of those same tools on that side. There is a statute, I think it's 17B, it's in the social services statute, that does require anybody who is a financial agent to undergo training when dealing with people in a population of over 60, I think is how the statute reads. So there is already in place some mandatory training, under that statute. This strengthens that by, if a bank or a credit union, depository institution is going to rely on the safe harbor from civil and administrative action, if they put a transaction on hold, this requires more structured, more in-depth training. And to the co-chair's point, to be fleshed out a little bit more as we go through this legislative process.
Thank you.
And what I can commit to you is that training would be more specific, and it will have some major components, no matter who the institution is, and some basic rules that they will have to follow. And if that means they have to modify what they currently do, if they want the safe harbor, they will have to, or otherwise I will not approve it.
Thank you. Thank you for that commitment. Thank you for your work, certainly on this very important topic that affects so many residents and folks around us daily, and certainly your work in protecting folks over your career, both here and before that is certainly noted. Just one follow-up question, if I may, around, and I know you're very articulate on the point before, Commissioner, around reasonable transactions and balancing what needs to happen on a daily basis, and then looking at and protecting with fraud. Just a question of interest in terms of your role and the relationships with the industries that you regulate. Do compliance departments reach out now if they're suspecting a fraud, or if they have a case that goes up the chain very quickly within a financial institution, that they may be suspecting fraud, or they may be suspecting that something may be going on, and that results in their legal department, their compliance department getting involved with the financial institution. Is there give and take right now with the banking department, with the commission, with looking for guidance or looking at ways to assist in individual cases as they arise?
From time to time, that does happen, and it happens through Matt's area. So I would allow him to, I will ask him to add after I finish. But let me give you one example. It was just before COVID, right? It was about 3 years ago. There was a case in Putnam, and the bank was very adamant and very confident that this person was being taken advantage of, right? And it was a case of a person who was giving money to someone down south to build a church, right? Your typical type of red flags and so forth. And they were very positive about it. They tried to, they didn't have anybody that they could contact. There was family member. They tried to convince her not to. So she was coming into the bank and she said, I'm closing all my accounts because you guys are giving me a hard time. And so the bank did approach us, right? And we involved this Secret Service and FBI and Department of Justice on it because we got a heads up on it. And as she was in the bank, the members of the FBI showed up, and she got a phone call from the fraudster saying, you need to leave the bank. You need to do this immediately because your house is on fire. Obviously, law enforcement calls the fire department, asks if there's really a fire going on in the house. They tell them no. So they all try to rush to the house to try to see if the fraudster's still there. And sure enough, as they're getting there, they think that he was there and there was a car that left, and they could not catch up with the vehicle. So to answer your question, yes, it happens from time to time from both sides. From the consumer side, relatives, we think the banks are being too restricted at times. And from the banks and credit unions and other financial institutions who feel they don't have the necessary tools to be able to help and prevent some of this fraud happening. I think with this law and the fact that they want to have the safe harbor, that interaction will happen more often.
Certainly, thank you for the real life example and how this does, happen more frequently than people think, and having a responsive agency like yours to be able to have financial institutions and other partners be able to freely reach out to you and to continue to work on these important things as this gets fleshed out. But again, I just want to thank you for your commitment for working with seniors and everyone else that we all serve, and for your continued work as we all move forward on this together. So thank you, Commissioner, and thank you, Matt, for your answers, and look forward to continuing to work with your department.
Thank you,
Thank you,
Mr. Thank you, Representative, and to your whole committee, because this is a team effort. And I can assure you that on a regular basis, we hear from many of you with concerns, and we appreciate that. And I have an unbelievable, wonderful team back in 250 Constitution Plaza that make all this happen.
Thank you, Commissioner. Are there any other questions from the committee? Seeing none, thank you, Commissioner and Matt, for joining us today.
Thank you. Pleasure.
Thank you for the opportunity.
Next, we have the Attorney General, William Tong. I believe I saw him online. And I don't know if everyone's from the office is going to vote to, should I call them all? Mr. General.
Madam Chair, how are you? Nice to see you.
I'm well, thank you, sir.
Chairwoman Miller, Chairman Doucette, Ranking Members Berthel and Delnicki, thank you so much. It's good to be home in the Banking Committee, where I was chair for 4 years. I am sorry I can't be with you in person. I've been a little under the weather, so I'm trying to stay away from folks until I'm better. I'm joined, as you mentioned, Madam Chair, by my colleagues, Kara Passera, who's the Chief of Staff, and also the Chief of our Finance and Revenue Services section, Phil Miller, and Assistant Attorney General Pat Ring, who do our enforcement work. And I'm here this morning to testify in support of House Bill 6681. I want to thank the committee for raising this bill. And it really touches upon a lot of what the commissioner talked about this morning and the department in terms of protecting consumers from scams, including seniors as well. Let me say first that the Attorney General's office, in particular, our consumer protection folks and our finance and revenue services lawyers are extremely busy right now and not in a good way. Since M&T Bank took over People's United Bank here in Connecticut, we've been working on over 400 complaints in the Office of the Attorney General. And I'm sure many of you on this committee and the department have also seen your fair share of complaints. And while I'll acknowledge that M&T has been working directly with the Office of the Attorney General to resolve those complaints, still months later, those complaints continue and many remain unresolved. There are still residents who have powers of attorney, for example, over a parent or a loved one that can't get access to funds on deposit to make important financial transactions for the people that they care for. There are people that expect to see their paychecks directly deposited into their account and are surprised to find that that money isn't there. Or they're finding that large amounts of money suddenly disappear from their accounts and they have to fight with the bank to get the money back into their accounts. And so this is a continuing challenge for us here in the Office of the Attorney General. And we continue to have to put pressure on M&T to make it right. At the same time, as everybody knows, Stone Academy has closed, and now more than 900 nursing students are left hanging, many of whom paid tens of thousands of dollars upfront, borrowed tens of thousands of dollars in student loans to try to go to school to become nurses. And now each of these students faces a crisis of how to continue their education. And they're looking to us in the Office of the Attorney General, the Office of Higher Education, the Department of Public Health, and the legislature to step in to try to protect them and to help them continue their studies and recoup the investment that they've made in their education. And then, of course, on top of our work in protecting the students at Stone, I see my friends from AARP in the room and the red shirts. I want to thank the committee for focusing on the exploitation of seniors every single day in the Office of the Attorney General. We receive complaints about fraud, financial fraud, and abuse, particularly against older Americans and senior citizens here in Connecticut. And so when you think about just those three examples of the work that we do in the Office of the Attorney General, I think if you asked residents here in Connecticut anywhere, they would want the state of Connecticut acting through the Attorney General to have the full range of power and authority and tools at our disposal to protect consumers and families here in Connecticut. And what the federal government did in the wake of the financial crisis in passing the Dodd-Frank Wall Street Reform and Consumer Protection Act was to create the Consumer Financial Protection Act and the Consumer Financial Protection Bureau. And as part of the CFPA expressly delegates authority to the states, acting through its attorneys general, to enforce the terms of the CFPA and to use federal law to protect depositors at M&T, to protect students at Stone Academy, and to protect seniors that are victims of fraud and abuse, and so many others. And under the CFPA, right now, the Attorney General can go after and sue a bad actor, a financial institution, a bank, a lender, for abusing consumers, and then can get information in discovery. What is not clear is whether we can first serve a subpoena before we file suit to get information, determine whether a lawsuit is appropriate. So it's a little bit cockeyed, if I might say, that the law creates a system where we have to sue first before we can investigate. Whereas in the normal course in our consumer protection work, you would want to investigate first before we sue. So we're asking the committee simply in this bill to make sure that it's clear in state statute that the Attorney General's office has the ability to conduct a thorough investigation first, to serve subpoenas, to propound interrogatories, to examine witnesses, and then decide whether a lawsuit is necessary. It's a very simple bill. It fills, I don't want to call it an enforcement gap so much as we already have the enforcement authority, but it spells out and clarifies our enforcement authority so that the Attorney General's office and the state of Connecticut can be there for consumers and for depositors and residents. And with that, Madam Chair, I'm happy to take any questions. Thank you.
Thank you, Attorney General Tong. Are there questions? Well, before we move to the first question, I want to personally thank you and your team for the work that you did doing the purchase of M&T Bank, I guess United People's Bank by M&T, and that the residents of this state had a place to go to lodge their complaints, and that's as well as the Department of Banking. And I forgot to thank the commissioner as well. So I know that you played a major role in trying to resolve some of the problems. I just hope that on a federal level that the legislators in Washington would hold these federally chartered banks more accountable, because this committee only has cognizance over state chartered banks. But again, I want to thank you for bringing this legislation forth and the work that you and your team have done to protect the residents of this state. Representative,
Chair.
had your hand up.
Thank you, Madam Chair, and thank you, Mr. Attorney General. I do want to echo the comments of my co-chair and thank you and your office for the work that you've done throughout the M&T merger. I think it was important to have your office play a role. And as my co-chair alluded to, because of the way banking regulation works and the dual banking system, and the fact that we had an entity in M&T that was an out-of-state chartered bank, our regulatory authority only went so far. Our regulator could only do so much. It's a hard thing to have to explain to our constituents who are experiencing these problems, that the way banking regulation works and the fact that you have an out-of-state entity, or whether you have a federally chartered entity, and it's not a satisfactory answer to give someone who's experiencing those problems in the moment. There's only so much that our regulator, that our state bank department, that our state legislature can do, which is why I think it's important that the Attorney General's office plays the role that you play. So I do think it's appropriate. And we also had another bill in our committee this session to try to establish a ombudsman, we call it, within the banking department, just to help with those sorts of complaints as they come in, because there is a role of for them to play as well within their regulatory powers, and to the extent of their regulatory powers. I did want to give you an opportunity to talk, and you touched on it a little bit, about the statutory framework that has been created both by Dodd-Frank and then the adoption of the powers in Dodd-Frank by this legislature, I believe maybe 2015, or I could be wrong, maybe earlier than that, that established, as you referred to, your enforcement authority, and why we're taking this additional step now, and what we see in other states, other attorney generals, do they have these sorts of powers? Because again, the Dodd-Frank framework established this process for state attorney generals to assume these sorts of powers. And I think that's important to highlight. This is not a novel approach that we're taking, that there are other state AGs that have these powers and have established these powers over the years.
Thank you, Mr. Chairman, and thank you for your very generous comments. And as you know, it's my team, and the lawyers and staff and the Office of the Attorney General who do all of this work, and they work very hard and fight really hard for the people of this state. I couldn't agree more. One of the hardest things we do as public servants, particularly in law enforcement, is when somebody says, I'm in real trouble here and I need your help, and you have to give an answer that there's only so much I can do under the law, given the powers that are given to us. And that's why it's so important that law enforcement agencies like the Office of the Attorney General have the full range of authority and tools at our disposal to protect Connecticut residents and customers and do everything we can to fight for them. And you see that playing out every single day with M&T and its treatment of its customers and its acquisition of People's United Bank. And let me say, we're not done. It's ongoing, and that's what's so frustrating. And it shouldn't be this way, but because it is, and because people are still having trouble, it really does help to have the Attorney General's office and law enforcement on your side to try to make it right. And I think that's what Senator Dodd from Connecticut realized during the financial crisis, that we need to give more tools to consumer protection, to law enforcement, and to the states to protect people from financial misconduct and fraud and abuse. And that's why under Dodd-Frank, not only did they create the Consumer Financial Protection Bureau and the Act, but they said explicitly states are empowered to enforce the terms of this federal law. And then they delegated that authority specifically to state attorneys general. Many of our sister states passed expansive, comprehensive laws implementing Dodd-Frank under state statute. And many of my colleagues exercise that authority today. And many of my colleagues have authority under their state laws where it's clear they can exercise investigative powers before they have to file a lawsuit to vindicate financial harms and to protect consumers in their states. So Connecticut did most of that, and Connecticut did essentially codify Dodd-Frank under state law and say, yes, we acknowledge the federal government delegated that authority to us, and that we act through the Attorney General in enforcing the terms of Dodd-Frank here in Connecticut. But we didn't spell out that the Attorney General has investigative powers like subpoenas, like examining witnesses, that we can exercise before we file suit. Now, there's a good argument that authority is implied in the ability to file suit, but as you know, Mr. Chairman, it's always better to be sure and to make sure that that's clarified under state law. And so that's why we're here today, to make sure that it's clear that we can serve subpoenas and conduct an investigation before we file a lawsuit.
Thank you for that answer. Again, I think that's a reasonable approach, and I think it's goes to show that it's not a novel approach that we're taking here. So I appreciate you bringing this to us. Like we referred to earlier, this is another bill that we've seen before, but sometimes these things take a few years to work their way through the system. So I appreciate you being here today, and thank you, Madam Chair.
Thank you. If I may, Mr. Chairman, may I add quickly that because we've been before this committee before, we received a lot of really important and constructive feedback from the committee, from the Connecticut Bankers Association, from the department. In the previous iteration, I think almost all of those comments from last year have been incorporated into this draft. And so we're always open to have a conversation about the legislation that we suggest the legislature take up, and this is no different.
Thank you, sir. Are there other questions from the committee? Representative Delnicki.
Thank you again, Madam Chair, and thank you for coming forward, Mr. Attorney General. Did I hear you correct that there's still folks that haven't gotten access to some of their funds from M&T?
There are still folks who are having trouble. Sitting here today, I don't know exactly as of 11:04 a.m. What's happening with the specific complaints that people have lodged. But yes, we're still struggling with people who file complaints, who are having trouble getting access to funds, who are having trouble moving money at the bank, who are having trouble accessing funds for people that they're taking care of through a power of attorney. So yeah, there are still people who are having trouble getting access to their money.
And we're 6 months in to the actual merger at this point, right?
Yeah, one of the frustrating things is that, as I acknowledged in my testimony, M&T has been responsive when I call. But my frustration is it shouldn't take a call from the Attorney General's office for the bank to do the right thing. And it seems to me that there are still systemic issues within the bank, particularly around powers of attorney, for example, where they haven't made a system-wide change, or they haven't made the system-wide adjustment so that M&T and people's processes are fully merged and working properly, so that when people walk in and they're a former People's Bank customer, they get treated the way they should, and they get treated the way that they did when they were a People's Bank customer, now a customer of M&T. So it's some of these system-wide issues that have not been resolved. And so people still walk in the bank, they try to do something for their mom or their dad, and they have the power of attorney, and they can't get it done. And it's very frustrating. And I'm sure they have to get on a phone, and they're on hold, and they have to take time out of their day and away from their job or taking care of their family. And then finally, exasperated, they call the Attorney General's office. Now, to be fair, when we call, somebody at M&T jumps on it, but it shouldn't take that. It shouldn't take all of those hoops and hurdles before something gets done.
Well, I can attest to that situation you just described, because I had a number of constituents that had that exact issue when it came to trust accounts. And I too ended up making that phone call and getting it resolved. I'm just surprised and quite frankly shocked that it's not totally resolved 6 months later.
It's unacceptable. It's shocking to me. And frankly, it's frustrating to me that sometimes the response of the bank as well. There's thousands of other people that have had a good experience. Well, that says nothing about the thousands of people I presume who have had a bad experience, right? And the hundreds of people who we've talked to directly who've either had a bad experience or continue to have a bad experience. And by the way, you and I both know, Representative, that there are a lot of people who had trouble that didn't have the time to call the Attorney General's office, that didn't have the stamina, right? They have to live their lives and run their businesses and do their jobs and raise their families. And I'm sure there are many, many instances of failures by this bank that did not go reported.
Well, it certainly brings a lot of credence to choosing a state chartered bank or credit union to do your banking with. And again, food for thought here. Thank you, Mr. Attorney General. Thank you, Madam.
Thank you, sir. Are there questions from the committee? Representative Paolillo.
Thank you, Madam Chair, for the opportunity. Good morning, Mr. Attorney General. Thank you so much for being here, and thank you for your work and for really providing folks with having someone to go to, especially around this transition, and having someone work on their behalf and being able to resolve some of these issues quickly, but knowing that there was someone on their side. So certainly that's appreciated in your ongoing work. I did want to follow up on the good Representative Delnicky's questions, because as we're testifying, and I was reading your testimony again today, you had mentioned still ongoing. How many cases overall has your office worked on or heard from folks or have resolved as it relates to this transition here with M&T?
More than 400. And let me say, Representative, that's a lot. My 4 years, in my 4+ years as Attorney General, I rarely seen a consumer issue with this many complaints.
How many are still outstanding? Mr. Attorney General?
There's frankly some reconciliation going on about that. We think it is more that are still outstanding. The bank has a different view. So to be fair to the bank, we're working that out, but suffice it to say, there are still open cases.
And I read your testimony and a couple of other pieces of information that has come forward to us and related around one of the issues that folks had with when they have automatic payments come out of their accounts and the dates changing. And I have read from your testimony and again, some other supporting documents that some folks have been made whole on other issues. How would that work in terms of folks paying, maybe mortgages to other financial institutions or paying insurance premiums or having other bills on automatic pay, automatic deduction when those dates change and they may now be overdue, or there may be, a lapse possibly in coverage or other adverse things that would occur when you're not on time. Is there any indication there how folks have been made whole or how they can be made whole there?
So that's been a real slog, as you know, Representative. One of the biggest failures was in automatic bill pay. So many of us, including the Tong family of Stamford, relies on automatic bill pay, right? And once you've set up a payment system, you expect those payments to be made, and you don't expect to incur late fees or worse, a collection action. And there were a number of consumers, M&T Bank customers, who were prejudiced by the breakdown and automatic bill pay. And that was one of the very first things that I personally said to the bank when I demanded that they work directly with us in resolving every single consumer complaint on a daily basis, which they agreed to do. But I said, you have to make these consumers whole. If they incurred a late fee or worse because of your failure, you have to step in there and pay for it. I got mostly a commitment that they would do that. The language that I got from them wasn't as strong as that I would have liked, but they basically said that they would do that. And I think by and large, the bank has stepped in when it was their fault. I don't know if my colleagues have anything to add about that, but that continues to be a struggle. And where consumers have lost money, we fight for them to make sure the bank pays them back for it.
So thank you for that ongoing advocacy and working to resolve those issues. I wanted just to ask a practical question. You mentioned around being able to subpoena or to compel and to receive information, to request information. Around this whole power of attorney situation and for whatever reason not merging in these last 6 months, if you were able under 6681 to show that pattern there, but I just think as a practical task here, that you would be able to have those documents that are on file or should be on file with an institution, with any institution, as they're being recertified year to year or every 2 years with power of attorney or with other documents that give folks the ability to act on behalf of someone on an account, to be able to show that this actually does exist and these folks should be able to act without delay if it's within the contract or if it's within the POA documents. Would that have been able to resolve some of these issues more quickly if we would be able to, through your office, as the complaints are made, to be able to have been requesting those documents in real time?
No doubt it could have, and in other contexts, not in the M&T situation, but when we commence a consumer protection investigation, very often that investigation will spur the target of the investigation, not just to provide information, but to resolve problems and do the right thing. And it's part of bringing the full weight and authority of the state of Connecticut to bear on pushing somebody or a financial institution that isn't doing the right thing to step up and make it right for their customers. And so not only would an investigation spur them to action or enable us to resolve issues on the ground with specific Connecticut customers and residents, but it would have informed, frankly, what this committee could do with respect to powers of attorney and to pass legislation to protect future customers that may face this situation. It could have formed the basis of a lawsuit if that were necessary. And let me say again, this would be the preferred course, right? Which is for us to conduct an investigation, to see what's happening, to try to get some action on specific cases, and then maybe come to the legislature and say, this is what we're seeing. You should make some changes in the law, as opposed to where the way it stacks up now, which is we have to sue first, then we get to ask questions.
And on that point with the oversight and with suing and taking possible actions with 6681, can you just kind of clarify for me with this ability going with chartered and unchartered banks, how that kind of interplays with the Banking Commission with possible actions in the future, or if there was investigations where the banking department was there already? Can you just kind of talk a little bit about the AG side and if there was something going on with the chartered bank and if an ongoing investigation by the banking department, how that all kind of plays out under 6681?
Well, under 6681 and under Dodd-Frank, it covers both. It covers, frankly, any financial institution doing business here in Connecticut, and enables us to enforce the terms of the CFPA to a fullest extent. And it continues what is already the case: concurrent jurisdiction with the Department of Banking over state chartered banks. And, right now, for example, when the Department of Banking wants to bring an enforcement action against a state chartered bank, we're the muscle, right? It's the Office of the Attorney General that steps in and provides the legal muscle to do that for the Department of Banking. So this is a continuation of our concurrent jurisdiction, where the banking regulator serves in its role as the regulator and making rules and policing those rules. But at the end of the day, it's the Attorney General's office that comes in with the muscle to enforce what the Department of Banking wants to see happen.
Well, again, thank you for the testimony today, and thank you for the answers to the questions, and obviously your ongoing advocacy and work on behalf of the people that we all serve. Really appreciate it. Thank you, sir. Thank you, Madam Chair.
Thank you, sir. Are there other questions from the committee? Seeing none, thank you, Attorney General Tong and your team for testifying today.
Thank you, Madam Chair.
Okay, moving on. I believe next on our list, I have Detective Hogan from the Connecticut State Police. Is Detective Hogan with us on Zoom?
I'm here,
There you
sir.
are. Welcome.
Good morning. Thank you, Honorable Representative Doucette, Senator Miller, Ranking Members Delnicki and Berthel, and other distinguished Banking Committee members. My name is Matthew Hogan. I'm a detective with the Connecticut State Police, assigned to the Eastern District Major Crime Squad. I'm here to testify in favor of the proposed Bill 6752, an act concerning digital assets. Thank you for the opportunity. Over the last 7 or more years, I've noticed a significant gap in law enforcement attention on financial crimes in Connecticut. Because of this, I've attained several specialized financial crime certifications, as well as my master's from the University of New Haven in financial crime. While working financial crime cases as a detective and task force officer, I've discovered several serious trends affecting our citizens, the targeting of elders and scams involving cryptocurrency. Because of this, I've also attained some specialized certifications in cryptocurrency investigations. Currently in Connecticut, there are approximately 511 cryptocurrency kiosks, virtual currency kiosks. These kiosks allow users to purchase or sometimes sell virtual currency such as Bitcoin with cash or debit cards. And unlike regular fiat ATMs, these kiosks do not connect to a bank but to a cryptocurrency exchange like Coinbase, where they convert your fiat money into Bitcoin. You can then send that purchased Bitcoin to your digital wallet or someone else's, which is the case in most all cryptocurrency related crimes. Here is where the problems begin. There are at least 20 different virtual currency kiosk companies, and there is no standardization and customer verification process from company to company. Some of the industry leaders in this space have already put together a zero threshold limit for the collection of KYC data, such as Digital Mint and Byte Federal. So there's no good justification for others not to do the same. These kiosks are being used to target non-crypto native victims. Money muling, frauds, scams, terror financing, CSAM consumers and vendors, as well as carding and PII shops all have exposure. Transaction limits can range anywhere from $0 to $3,000 before requiring any type of photo ID from the customer. And fees can range between 11 and 25% above the spot market price. Scammers take advantage of our citizens from these kiosks as a vehicle for their illicit activity. I and another detective had taken upon ourselves to assist with the growing daily victim list, all commonly over the age of 60. These victims have lost anywhere from $3,000 to several $1 million, all in Connecticut, all using cryptocurrency ATMs. Luckily, we're able to locate and seize some of these stolen assets using our tracing software Reactor. Having tools offered by services such as Chainalysis and others is a critical part to serving the investigative needs of any cryptocurrency-based illicit activity. A partial solution for these kiosks is in proposed bill 6752, which I ask for your support. There are additional measures, but I only have 3 minutes here. To understand how big the problem is, Chainalysis' 2022 crypto crime report states that scammers have collected over $3.5 billion from victims, and note that the average victim transfer to a scam wallet was over $1,000. More specifically, according to TRM Labs, over 40 million was sent in 2022 to known scam addresses via cash to crypto services such as cryptocurrency ATMs. In closing, the proposed changes would help law enforcement and regulators detect, investigate, and prosecute financial crimes that have been targeted all victims, including older adults, by creating and preserving an information trail. I yield the rest of my time back.
Thank you, Detective Hogan, and thank you for the work that we do. We had the opportunity to meet and discuss this, and frankly was blown away as to some of the things that have to happen on your end of things to try to unwind these fraudulent transactions when they take place. Luckily, there is technology that law enforcement can take advantage of, as I understand it, to help recover those fraudulently obtained funds in some cases, if there's enough time to do so. But I think you also highlight that the current lack of regulation in this space makes your job infinitely harder to do. So that's why we need why I think we need this bill, and we need to continue to look at this and give the Department of Banking the authority to promulgate regulations where necessary. I did want to give you an opportunity to talk about some of the specific changes that are being proposed in this bill and highlight, based on your experience, why they're necessary. I know
Sure.
We're looking at lowering the transaction dollar limits on these kiosks, and we're also looking to change the type of regulatory license that would be required to operate one of these kiosks, perhaps, but just give us kind of the bullet points of what the changes are that are in this bill.
Sure. I mean, first off is obviously the definitions. You can't start anywhere without having definitions. So a lot of these kiosks aren't currently regulated in Connecticut as money transmitters. They are regulated through FinCEN under the Bank Secrecy Act as as MSBs, but not in Connecticut as money transmitters. So that it makes things indicatively harder for us with the collection of data. As far as the transaction dollar limit, we're looking to lower the threshold so that victims, if they are transacting on these machines, they have the ability the machine collection has the ability to capture victim data more often than not. And it also will give, hopefully, the suspects or the people requesting the money less likely of an opportunity to transact, because they're not going to want to have these people going to 6 or 7 or 8 different ATM machines to transact their cryptocurrency. Like we said, typically it's $1,000 or more that they're transacting. So if we lower that limit, it's going to create a problem for them for these people to go to multiple machines and then having to verify their identity over and over again. So we're hoping that part of that process takes place there, and we can actually have these kiosks operating a blockchain analytics software, much like Chainalysis or TRM or any other organizations, so they can trace these transactions to where their destination is heading. So that's a couple of the major points that we want to see. Obviously, one of the bigger ones too is regarding our elders. One of the things we really want to have happen is anytime the ATM customer begins their customer verification process. Once the ATM company recognizes this person meets the definition of 17B 450 as an elder person, we want them to automatically freeze that transaction. And the purpose for that is obviously for them to contact that person over the phone and make sure that this transaction is legitimate and it's not part of a scam. We also want to have things. If you go to one of these machines right now, it's kind of ridiculous. They have a very small font and it tells you, hey, this is this could potentially be a scam. If it's a scam, stop what you're doing. It's very small. A lot of times it's not standardized. So we're asking for something very simple, which is increase the font size for the machine's notification to the customers to say, hey, be careful. This may be a scam. If it is, contact this number below and we can assist you, or to contact IC3 or local police departments. So those are a couple of really big changes we want to see happen.
Thank you. Appreciate that. And there's you may not be able to see, there's a whole cadre of folks from AARP here in the room. And I'm sure they appreciate that as well. So thank you again. Other questions from the committee? Representative Hoxa.
Thank you, Chair Doucette, and thank you, Detective Hogan. I can certainly speak for everyone when I say that we appreciate, your testimony. The question that I had was, and you may not necessarily be able to, answer this, but I'll give it, I'll ask you anyway and see, how much you know specifically about the inner workings of how crypto works. Excuse me. Insofar as, it is when you go to one of these kiosks and you put money in, and crypto, quote unquote, digital currency is sold to you. It comes in the form of some sort of code, I'm sure, which is probably the reason why it's difficult to trace, as far as, the originator of, the currency, or who held that, currency, that asset prior to it being sold for cash. Is part of, like, your evolution in, your technological capabilities, being able to make it easier to track down, specifically what entity or individual sold the cryptocurrency to, to the elder, or anyone really that can be a victim of this, type of scheme. Because it obviously does happen very frequently with elders. And I'm very sympathetic to that. Having worked in retail banking, I would see the scam all the time, and it always broke my heart, because they're, very vulnerable and come from, a generation where this kind of stuff was not even, remotely, possible. So, but can you just, kind of like talk a little bit more about, like, if you can, if it's something you can even disclose,
Sure.
some of the technological advancements that you've made insofar as being able to trace back, the identity of the entity or individual that, perpetrated the scam.
Sure. Thank you for the opportunity, sir. I actually just helped a Plymouth police officer the other day with the investigation, so I can feel your concern with your constituents. As far as the technology goes, without getting into crazy detail with it, basically every time you do a transaction, it creates a specific wallet address. And typically what happens for these machines is they're already being scanned by someone. So say the older person is on the computer, they get a pop-up screen that says, hey, your computer's been hacked, contact this number. They go through the process of talking to the scammer, and then they're directed via phone to go to one of these cryptocurrency ATM machines, usually specific ones. So the victim will then go to these ATM machines after they withdraw cash from their actual institution itself. And when they approach the ATM machine, they're usually text messaged by the scammer a wallet address that they want them to send the money to. So once you go through the verification process, which, like I said before, a lot of these don't really have one. Many of them are simply just an SMS text message to your cell phone. Then that's their verification. They don't check your ID. They don't do anything. They just do the text message verification to your phone. So you then scan the wallet address where you want to send the money to. You insert your cash. The cash is now converted into the currency of choice, which is typically Bitcoin, and then it's immediately sent to the wallet destination that it goes to. It is pseudo anonymous, so thanks to software like Chainalysis, TRM, Blockchain Intelligence Group, these other organizations, we have the capability of tracing that money a lot easier because it is open source. It's on the blockchain. You can search it very easily. You can use it on blockchain.com or any of these other websites. You can do it yourself. the purpose of the software is to make it more visually readable and easier to trace. And they collect a lot of back data that kind of clusters information together so they can attribute what that wallet is belonging to. So a lot of times they'll say, okay, this is a Coinbase wallet or this is a Binance wallet. We can't do that without that technology. And then to your point, to advance with that, these programs aren't cheap. We had to use grant money or seized assets to pay for this. It's not a line item budget for the state police. So every year, it continues to be, it would be continue to be an issue for us to obtain the software unless it's paid for. So it's going to be always be an issue trying to trace the software unless we have trace the transaction, unless we have the software available to do it. And as you know, a lot of these, this isn't going away. It's not going anywhere. So we, as I told you, we already had a Plymouth officer. I had another officer email me this morning from a local PD. We have victims reach out to us directly via email with losses. We have a woman from West Hartford over $200,000 in losses. We had a gentleman from the southeastern part of Connecticut with over $6 million. So the vast array between 10,000 and millions of dollars is lost to these victims unless we're able to trace those and at least attempt to regain some of their money. And we can't do it without the software.
Thank you, Detective Hogan. That I really appreciate that answer, and you doing you helping out the police department in my district, and the police and victims all over the state for that matter. We really appreciate that. And that's all I got for you. Thank you very much.
Thank you, sir.
Appreciate it. Thank you, Mr. Chair.
Rep. Delnicki.
Thank you, Mr. Chair. And I want to thank you for bringing that issue forward to us, Trooper. That was a real eye-opening call that we received that afternoon. It's interesting. I did a quick search and I found at least one or two of these machines in my own town, South Windsor, of course, Manchester, Vernon, and the general area. The bill before us, 6752. Are you fully comfortable with what we have there? Any pluses, any minuses, any changes?
Thank you, sir, for the opportunity. I think it's a great start, like everybody else is saying. I think there's always room for improvement. And I think in a space like virtual currency and cryptocurrency, it's going to be ever changing. So I think there obviously needs to be room for that. I would like to see other things to make my life easier as a detective. So some of the things would be like having administrative subpoena power, because as you know, these transactions occur very quickly. And right now we're working under the guise of search warrants. And typically those can take a day or two more to write. And then we have to get them approved and then sent off to these organizations like Coinbase or other places. And it becomes very cumbersome. So having that ability would certainly cut down the time. But some of the other things that we would like to see, obviously, is more of a personal thing, would be having an actual unit within the state police that deals strictly with financial crimes, because right now we're, as you know, spread pretty thin as an agency. So for us to take on these cases, not just cryptocurrency, but financial crimes in general, these cases are lengthy. They require a lot of attention, a lot of typing. So to have a unit that could actually take the time and effort to actually give it the full attention to these things would really be beneficial. But I know that obviously can't be part of this bill. So as far as consumer protection parts go, I think that what we have here is certainly a great start for us. But I think that as we work with our constituents and AARP and other organizations like the Elder Justice Coalition, we can make more and more changes to make this better.
You spoke to the concept of having to get a search warrant, and that took or takes a day or two. At that point, is the trail that thin, or is there still a trail that you can follow?
Thank you, sir. The trail always exists. It's going to be there forever. The question is whether or not we can get to the assets quick enough to potentially seize and return them to the victim. So by the time we get through a search warrant process, a lot of times this money has moved 3 or 4 hops to a wallet that is now overseas with an entity that we have no jurisdiction in. Luckily for us, there are some of these exchanges who are cooperative with U.S. law enforcement strictly on letterhead. but that number is fleeting. So search warrants certainly are extremely cumbersome to get this process through as quickly as we need to. But it also, I think it has to do with the education on the subject. As we know, it's very can be very confusing in general. So we have to get these topics and definitions and explanations across to everyone from state's attorneys to judges and to our supervisors. And that takes time.
You spoke to losses and you mentioned $7 million.
Over 6, sir, yes.
Recovery made on that, or?
Not yet, no. It's again, when you talk about that kind of a dollar amount, the sophistication behind it is pretty high. So they'll do as many different layering techniques in the money laundering process to obfuscate where they're putting the money. They'll transact it with and bridge it with other tokens. They'll move it to other blockchains. They'll change it to other things to make it more confusing for us. So a lot of times it actually requires expertise above my level, and I'm by no means an expert in this. So we have to reach out a lot of times to the organization that we pay for the software to kind of get some pointers to see where it's going, or we reach out to some of our coalition members within our working group to see if they can kind of help us point it in the right direction.
But administrative subpoena power would give you another tool in the toolbox and make it more effective for trying to track these folks down.
It would, sir. That would cut down our time to get to where the wallet is going and the address is going a lot faster.
Well, thank you for your testimony here, Trooper Hogan. You brought a lot to the table here, and I can only see this becoming a larger problem with the proliferation of these kiosks. And again, thank you for bringing it to us. And
can I actually
thank
add a point, sir?
Go ahead.
I actually reached out to Hartford Police Department and Bridgeport Police Department, who actively have an intelligence department, and I actually asked them to overlay the kiosk locations to their heat maps for crime. And when you do that, you can actually see a pretty significant correlation between the locations of these kiosks and where the worst crime areas are in these cities. So just a point to make.
You just brought another question to mind here with your comment there. Is the state police actively looking to reach out to local departments so that they can actually have a good exchange of information and be able to follow the trail?
That's above my pay grade, sir, but I'll say that myself and the other detectives who are working with the crypto actively are doing what we can to reach out to these local PDs. We have created a specific email address that we use for the local PDs. We've put out bulletins to all the local PDs, and we are getting contacted on a regular basis by agencies all throughout the state for assistance on this.
So then probably the right answer is we should reach out to the commissioner.
Don't want to get myself in trouble, sorry, I have no idea.
That's an even better answer. I truly appreciate your comments here today. You have really highlighted an issue that begs to be addressed. Thank you for your work on this, and thank you for your testimony here. Thank you, Mr. Chair.
Thanks, Representative. Senator Miller.
Good morning, Trooper Hogan. Thank you for joining us. And I hope I didn't miss this. I had to leave the room for a few minutes. I just have a question. We have people watching us today. As a consumer, what advice would you give me so that I wouldn't fall prey to this?
Don't use cryptocurrency ATM machines. They don't, between their transaction rates right now, between 11 and 25%, there is really no reason to use them. If you're a consumer and you want to purchase any kind of cryptocurrency, Bitcoin, Ethereum, any kind of token, you can easily open an account on Coinbase, Binance, KuCoin, any of these organizations, and purchase them doing ACH transfers from your bank. There's no reason to walk into the worst parts of the cities with cash in hand and transact on one of these ATM machines.
Thank you.
Okay, thank you, Senator Miller. Any other questions? Any other questions? Seeing none. Thanks again, Detective. One thing, just as you go, do you have written testimony, or does the department have written testimony that's been submitted?
I was instructed to give verbal, sir.
Okay, that's fine. Thank you.
Thank you.
Okay, moving on our list. Next on our list is Krista Estrada Perez. I don't see her here, and I think that may have been a holdover, perhaps a mistake from got confused with another hearing. So next on our list after that is Neil Karen. Neil, are you with us? Neil is in the room. He was in the room. Oh, there he is. Neil, welcome. I think you're on mute. You're on mute. Still on mute. Now you're off mute, but I can't hear you.
Can you hear me now?
Yes,
Okay,
there it is.
here I
Thank
am.
you, Neil. Welcome.
Thank you. Do I roll right into this, Jason?
Yes, sir.
Okay, Madam Chair, Representative Doucette, members of the committee, here to speak to SB 1084, which is specifically Section 1 of CHFA Time to Own. Representative Delnicki, great to see you as well. Shout out to South Windsor. My name is Neil Karen. I'm Vice President of Residential Lending at Homebridge Financial. I'm a Connecticut homeowner. I've been a resident of Connecticut my entire life. The challenges and barriers I encountered as a young adult purchasing my first home led me to the career I have today. I only wish there were programs like this available to me 25 years ago. I've been originating CHFA loans since I started my career in 1999. Our staff here has served on numerous housing advisory boards with CHFA over the past 20 years. We've always enjoyed our partnership and value our relationship that we have with CHFA. In our opinion, the CHFA Time to Own program has without question been one of the most impactful housing initiatives that CHFA and the state of Connecticut has ever introduced into our local housing markets. The housing market to date has been challenging to say the least. Rates, inventory, competition, the rapid and somewhat unsustainable rise in purchase prices are just a few of the current challenges in play right now. As 2022 year-end summaries are now starting to roll in, we're getting a clearer picture of what the short-term landscape is going to look like in the coming quarters. The Case-Shiller Index, which is one of our national modeling indexes that we follow, continued to show a 5.8% increase in home values nationally in 2022. That registered in the top half among the index's historical series. So what that means is 5.8% gain represented the 15th best performance in the 35-year history of the index. There was a modest 1.1% decline in home prices in December nationally. However, Connecticut saw a 4.9% increase in sold home prices in January alone. Inventory is the issue. In June 2018, there were 28,112 homes for sale in Connecticut. I pulled the numbers this morning. There are 8,407 homes for sale in Connecticut. That's a 70% decrease from the height in 2018. It also equates to about a less than 2 months supply of houses in Connecticut for buyers. Housing scarcity and affordability continue to be the narrative. The interest rate reduction, down payment, and closing cost assistance of a traditional CHFA loan are no longer enough. There are currently very few affordable purchase housing options available in Connecticut. And with inventory levels at historic lows, this has only further eroded the opportunities for the first-time home buyer in Connecticut. I'll cite a specific example. A single person in Connecticut making $56,000 annually can comfortably afford about a $1,500 monthly mortgage payment. So a $250,000 house, which is at the lower end of the median prices now, in a standard CHFA program would be a $2,300 payment, and they would probably not qualify at that level. Introducing the time to own as an option, that $250,000 payment now becomes $1,800 and would put them at a level of qualification.
Neil,
Yes, sir.
your 3 minutes has elapsed. So if you would just summarize quickly, and I think there may be some questions as well.
Yeah, that's okay. To summarize, the Homebridge and I think I speak for the entire lending community are not only avid supporters and advocates for CHFA, but we strongly urge the continuance of the program for the continued health and future success of Connecticut housing market. And we look forward to your continued support.
Thank you. One question I did have is if you could speak in your experience to the funding level of this program, and having watched it, as I'm sure you have since its inception, and how quickly the funds went. Could you talk a little bit about that? I mean, I believe it went live last summer, was it? And the funds at that time, and where they went. I know the industry kind of tracks it, the availability of those funds, and it's currently not being offered. Is that correct?
Yeah, I was getting to that point. So the first round of funding, I don't remember the exact million numbers that we had, so I'm not going to speak to that. But the first round that came out, we joined the program in June of 2022. We were a second round of lenders that were added to the program. In June of 2022, we thought the funds would last about 12 months. They were exhausted by, I believe, September, October of that year. We refunded again. We had funds that came in again in December. We were hopeful again that those funds would get us through to July of this year. And as of this morning, actually as of last Monday, that second round of funding is gone. So we currently, right now, speaking for our company, we have about 200 pre-qualifications of people that are qualified for the time to own program that will not be able to take advantage of that portion of the CHFA product.
And so fair to say that demand is strong, correct? And this is an important part of the market in terms of what you're doing and what you're able to offer over those last 8 months.
Yeah, so out of 400 pre-qualifications that we have in the last rolling 6 month, and a pre-qualification is somebody that we've talked to and we have physically approved for a loan. 44% of those are CHFA and time to own. And looking back in the last 6 months, 62% of our closed loan volume was CHFA, and 50% of those were time to own.
Wow. Okay. Any other questions? Representative Hoxa has a question.
Thank you, Mr. Chairman, and through you, Mr. Chairman. My question is, and I apologize, sir, I forget your name.
That's okay. Neil Karen.
Neil, I'm sorry. Thank you, sir. My question is, so, you gave the example of, a median house value these days is 250,000, and payment, your monthly bill, mortgage, taxes, insurance would be roughly $2,300 a month, which would be unaffordable for somebody that makes, 56,000 a year. And then I believe you said that due to your program, in that type of situation, the monthly bill would be roughly $1,800 a month. Did I understand that correctly?
I'm not sure, so I'll just restate. So the example was $56,000 annual salary would qualify for comfortably a $1,500 a month mortgage payment. There's some room to move within that. Under the standard CHFA program, without time to own, a $250,000 home would roughly equate to about a $2,300 a month payment, and that would be taxes, insurance, mortgage insurance, all included. Under the time to own program, adding in the grant, that $250,000 home, same exact scenario, drops the payment down to about $1,800, putting it within an affordability window.
And that would basically come in the form of just a reduction on the total mortgage amount, correct? Or lower interest rates also at play and things like that?
Interest rate would have been the same for both of those examples. This would be the reduction of anywhere from $25,000 to $50,000 with the grant.
Understood. Thank you very much.
Thank you, Representative Delnicki.
Thank you, Mr. Chair, and thank you, Neil, for coming forward and testifying on this. I think you've made the case as to how effective this program is, and probably the only issue is the fact that it's not funded adequately based on what you've said.
Correct.
Well, again, keep up the good work. And proud to have somebody from South Windsor testifying on this. Thank you, Mr. Chair.
Thank you, Representative. Any other questions from the committee? Okay, seeing none. Thank you, Neil, for joining us today.
Thank you for having me.
Okay. Up next, Rafi Podolsky.
Thank you very much, Representative Set, Senator Miller, and members of the Banking Committee. My name is Raphael Podolsky. I'm a lawyer with Connecticut Legal Services. I'm here on behalf of legal aid programs. Some of you have heard this testimony from me before because I spoke on the same issue last year. I'm here to speak on House Bill number 6691, which is a bill concerning credit card access to home equity loans, to home equity lines of credit. What the bill does is it essentially repeals a part of a Connecticut statute that says that with a home equity line of credit, you cannot access it by a credit card. You can access it by other means, but not by a credit card. And my belief is that the reason for that is that the use of a credit card greatly increases the chance that that credit card will be used for small purchases in the same way you would use any other credit card that you have in your wallet. And that would normally be unsecured debt. So you might be liable for a suit if you fell behind in payments and couldn't pay the bills, but you would now, those bills could now be, any judgment could be enforced against you, against your house. And the reasons I think it's not a good idea to go forward with the bills, first of all, it makes it too easy to use for small debts. And essentially turns transactions that would normally not be secured transactions into secured transactions. There are an awful lot of lawsuits in Connecticut over credit card debt. People fall behind in their credit card debts all the time and they get sued. Small claims is filled with judgments against debtors over credit cards, and for larger balances, those will be in the Superior Court. That has a collateral impact on the homestead exemption, which you've recently raised to $250,000, because a consensual debt is not protected by the homestead exemption. Judgments are protected, but not for consensual debt. So that if somebody forecloses on your mortgage, you can't cite the homestead exemption as a way that they can't take they can't put a lien on your home over that debt. And in last year, part of what I was told by the committee is that one of the reasons for doing this is it puts Connecticut banks at an unfair advantage. The theory being that federal banks can ignore the statute through the National Banking Act and through preemption and go ahead and engage in this activity anyway. Last year, sort of later in the session, I tried running my own tests to see what national banks were doing. And at least at that time, a sample of just a couple of banks where I inquired about this was they didn't offer this product in Connecticut. They offered home equity loans, of course, but what they didn't offer was credit card access. And at least I'll try and finish up. They enunciated to me they didn't do it in Connecticut essentially because of the Connecticut statute, which I believe is not protected by the National Banking Act because it's not a banking statute, it's a real estate statute. So I think the impact of this bill, if you approve it, is really to invite this kind of lending in, to invite national banks to engage in this kind of lending. It's not an equalizing, but it's actually an invitation in. So I hope that the committee would not move forward with the bill. I thank you for the opportunity to testify. I'm happy to answer any questions I can.
Thank you for your testimony. Any questions? Representative Santos.
Thank you, Mr. Chairman. Good morning, Mr. Podolsky. I understand where you're coming from as far as accessibility, but I think that's the intent of the bill, is to allow folks to have greater accessibility. And I'll give you my own example. Being at a Home Depot on a Saturday afternoon, having to access funds in my home equity line of credit, but not being able to do so because you have to write a check. And oftentimes the check processor is either wrong, or there's a coding issue, or in this case, because it's technically a loan, the check doesn't, tell you how much you actually have available there. And I think that's where, the proponents of the bill were coming from as far as accessibility to customers. I do understand where you're coming from as far as allowing folks to incur more debt. But I also think that there's a couple of issues, right? The level of responsibility that people have to have. And then also perhaps similar to what we do with a check is you have a $500 or $1,000 limit, right? That would eliminate the case where you're saying folks may be using it for everyday expenses. Truth of the matter is that some people who are using their home equity line of credit for everyday expenses are already doing it anyway. Because I see it on my professional side as well. But those folks are very few and far in between. So my question to you is, you mentioned that, do you happen to have, perhaps you don't, and that's okay if you don't, an amount of, or a number of home equity line of credits that have resulted in foreclosure debt that has resulted in foreclosure debt in Connecticut?
I didn't know.
Yeah.
I don't have any data.
Okay, yeah, I don't either, which is fine. But I would like to see that because I don't think that number is that high. And again, the other point of this legislation is to allow that parity there, right? Where some other states are already allowing this. I have friends who work in other states or have home equity line of credits in other states, and they do have access to that. I think it's also important that we keep in mind that we keep moving technology a little bit. We were just talking about, crypto and Apple Pay and everything else that you have on your phone. Making it a little more accessible for customers is really where we're coming from with this bill.
In terms of your question about data,
Mhm.
I'm not quite sure how one would get it, because what you're really trying to do is compare. I suppose you'd be trying to compare foreclosure rates in different states. Between Connecticut, whatever, you'd have to be able to identify foreclosure rates as related to home equity loans, and then you'd have to compare it in state in which there was a credit card option to try and sort of figure out. And then you've got the problem of what's causal and what's not. So I guess, which is why I said, it's not just that I don't have it. I don't even know how you would get it. You might be able to figure out some way to do it. But the other thing I want to say is the example you gave does in fact, I think, illustrate what the problem is. You're at Home Depot, you're buying something that now you're correct in saying you could write a check against your home equity line of credit, but for a variety of reasons for you, that's inconvenient. So instead, if this law passes, you just pull out your credit card and use it. That is something, however, that under normal circumstances, you wouldn't have used a home secured credit card for. You would have used a sort of a regular credit card that is not secured by your house. And the consequence of having made that choice, of it being so easy to just pull out a home secured credit card and use that card, is as long as you pay your bill, you got no problem. It's not going to make any difference. But what happens when you lose your job and now you're having a tough time paying? What you'll discover is now that credit card debt has become secured. It wouldn't have been secured. Now it's secured. So now your home is no longer protected on that debt, at least by the homestead exemption. And it's one thing if you're if you got the home equity credit because you were doing home equity home repair work, or you were getting it for the purpose of a new kitchen, a new something else. But once you've got that card, you can also buy coffee, with it. You can shop at the grocery store with it. Things that are quite unrelated to what might have been the purpose of getting that credit card in the first place. And that's the concern. The concern is that precisely because it's convenient to use, you end up using it for purposes that were never intended when you got the loan when you got that extension of credit in the first place. And it seems to me that if it is a little less convenient to use it, it pushes you towards thinking through whether this is the credit card that you want to use. You may at Home Depot have had multiple credit cards in your wallet. You wouldn't necessarily have to choose this one. And maybe you made a deliberate decision to use it, but I think there'll be plenty of people who don't make those distinctions between their credit cards and use it in different ways. I mean, that's all I'm saying is that's the risk. As a result, you increase the risk because it doesn't necessarily produce a specific result.
Yeah, thank you for that. And I'll push back just a little bit on that, just because, yes, I did have the option to use another credit card of mine with a much higher interest rate than I have on my home equity line of credit, right? And yes, I was using it for the purpose intended for home improvements. But again, I'll go back to, if I use my whatever credit card that's got a 12 or 13% interest rate, that's significantly higher than my home equity line of credit, which has a rate of 7% right now because of the Wall Street prime rate, which had about a 3% rate a year and a half ago, right? So I do understand where you're coming from, and perhaps again, we look at what limits we will put so that people don't use it for everyday expenses. If you have a limit of $500, that's all you nothing less than $500 you can use, or $1,000, whatever it may be. You're not going to go to the Starbucks and buy a coffee with it because it won't process. So I think that's something that our committee will look at as well.
Okay.
Thank you.
I think it's good if your committee does look at that.
Thank you.
Thank you.
Thank you. Other questions? Representative Delnicki.
Thank you, Mr. Chair, and thank you, Attorney, for coming forward with the testimony. I'm listening to this, and I did a little research on my part in my community. And of the 11 or 12 financial institutions, I think only 2 of them are state chartered. So if an individual was considering a home equity loan and wanted to have a level of flexibility that the good representative talked about, they're doing a home project. They go to Home Depot, they go to Lowe's, they go to the local hardware store to get the material to do the work. Only 2 of those financial institutions in my community would have been precluded from offering a home ec loan that has and I'm not sure whether it's a debit or credit card, but it would preclude them from wanting to take the loan out from a state chartered institution, because they would know, or they might not know, but they would find out if they went to the state chartered institution and the manager there said, well, gee, we can't give you a HELOC, a home equity loan with a debit card, credit card, whatever you want to refer to it as. And people are getting more and more awakened and astute when it comes to doing those kind of transactions. I spoke to a number of folks because it came up last year, and it came up again this year, and asked them, if you were going to go get a home ec loan, I'm talking just friends and neighbors, and you wanted to have a credit card, debit card, however you want to refer to it as, if the bank said that, no, you can't have that, would that drive you to another institution? And by and large, they were saying, yeah, because if I'm doing something, I've got a home ec loan, I'm doing a renovation, I wouldn't be able to use a card. And I really don't like walking around with a checkbook. And quite frankly, I pay my bills by check, but I would never walk around with a checkbook. How do you address that to those institutions in a community that are state chartered, that can't offer a product that all the federally and out-of-state chartered banks, credit unions can offer?
Well, right off the bat, the first thing is I think your assumption is wrong. The Connecticut law does not apply only to state chartered institutions. I mean, if you look at the statute, you'll see that it applies to all institutions, and also to non-banks. It also applies to non-banks. So that the assumption that they could go to a federal bank and get a loan with credit card access, I think is not a correct assumption. Now, I don't claim to have broad testing expertise on this, but last year I ran my own test by calling two federal banks, and 2 out of 2 told me the same thing. If my memory, I should have looked this up before today. I believe it was Wells Fargo and Chase, but I could be wrong on that. And I said, can I get a loan? I'm in Connecticut. Can I get a loan with credit card access? And they said no. So they said that Connecticut doesn't allow it. Now, I don't know if they've gone to their legal departments, I don't know if this whole process that we're having is going to stimulate national banks to create, to generate a challenge to the Connecticut law. But the Connecticut law applies to everybody. It does not just apply to state institutions. The issue is there's a National Banking Act that under some circumstances preempts state law. And the banks many times have argued on all sorts of state laws that you can't regulate them because it's preempted. And the reality in Connecticut, if you look at our banking laws, we have a lot of laws in Connecticut that apply to national banks. And maybe they comply with them, or maybe they don't. The whole foreclosure mediation program, which puts requirements on how debt is collected, it applies to national banks. I don't know if they've ever tried to challenge it or not, but the law certainly does not distinguish. So the question then becomes, is this law preempted? I don't think it's preempted because that's not a banking law. It's a real estate law. Could I be wrong? It's possible I'm wrong. I don't know. But given what seemed to be that at least some national banks respect the law and follow the law, I would not invite them to come in and start doing something that we are saying to all lenders in Connecticut that you can't do. And so in terms of your survey, instead of, I think that what you would need to do if you really want to do a survey on this is not ask the potential customers, potential borrowers, whether they would prefer to have something that's more convenient for them, but rather ask whether national lenders are offering this product. Now, if enough people push for it, then maybe the national lenders will start doing it. But that's the reason I said in my testimony that it feels like this is an invitation to national lenders to start pushing this product and start testing Connecticut law rather than an effort to equalize between national and state banks. When I testified last year, I took for granted that everybody except the state banks in Connecticut was offering this product because they were all ignoring the Connecticut law on the theory that they were free to ignore Connecticut law and do what they wanted. And then it turned out it certainly wasn't true for all of them. Maybe it's true for most, I don't know. But do you see the difference in the dynamic? Once we repeal the statute, then there's no reason for entities not to offer the product. So then it goes back to Representative Sano's question. Is this a product that we want to have in Connecticut? And if the answer is yes, then frankly, there's no reason why you would prohibit it being there. But if the answer is there may be reasons why we would not want this, or we would want to set a high maximum, 10,000, 15,000, something that would discourage its use on small things, then maybe that becomes the policy. But I think you have to start by asking whether this is a product that you want to have promoted in Connecticut, which is a balance of benefits and risks. And then based on that, you go from there. But I think the fact that people may say, yes, it's be more convenient, I'd like it. I don't think that's conclusive as to what you should be doing as a legislature.
It's interesting you make that comment pertaining to talking to a couple of banks and they said that no, they don't offer it. It's interesting because I stopped at a half a dozen of the folks that are not state chartered and found out that there was no problem in getting some of them refer to it as a debit card, but getting a electronic means to be able to access that home equity line of credit. And I haven't heard any discussion or commentary pertaining to the lack of preemption to federally chartered institutions and institutions chartered out of state, such as in New York. And I find that to be a surprise. I'm concerned about the fact that for a lot of people, and I've talked to a number of constituents about this, having the ability to tap a home equity line of credit and to do it with an electronic means was important to them if they were to apply for a home ec loan, because of the ability to utilize that card doing a home remodeling project. I think you'd find that most people don't walk around with a checkbook. I pay all my bills by check, and I wouldn't walk around with a checkbook. That's me. But I think we're putting our state chartered banks and credit unions at a disadvantage here. Somebody can easily go out and utilize a charge card with 29% interest and find themselves really paying a huge amount of interest if they don't pay off the credit card. I mean, I've got a great credit rating, yet I look at my charge cards and they're all in excess of 20% interest. So I think there's a level of fairness here in how we treat our state chartered institutions. And if we look at the dynamic of the folks that would have a HELOC and would go and do a project, and the disadvantage if they had to use a checkbook. And I would think that they might find themselves shopping around to find an institution that would allow them to get some electronic means to access the money. But that's just what I heard from folks I talked to. I thank you for coming forward, though, with raising that issue and bringing a robust discussion. Thank you, Mr. Chair.
Thanks, Representative. Representative Aniskovic.
Thank you, Mr. Chair. So I'm going to talk about the fact of where you said that you had contacted some institutions and they didn't offer a credit card. But I think the way that they're getting around that, because I can speak to my personal opinion, is that I have a home equity credit line with a large institution. They give me access to that on my online profile. So whether I'm on my phone, whether I'm on my computer, I have online access. So at any point, if I needed to access that money, I can just transfer it from A to B and the money's available. So I could be at a Home Depot and I want to go buy a big ticket item. All I would need to do would be to transfer that money from my home equity credit line into my personal checking account, and the money's there available immediately. So I think they're telling you that they're not going to offer a credit card, but that doesn't answer the full question about what they're really, how they're doing business, because they are giving you access to that money, because let's face it, at the end of the day, they want you to use the money. So large institutions are going to give home equity credit lines because they want you to use that money. That's a lending source of theirs. You know, as we're looking at the market that we're in now, I think the bigger issue becomes on the flip side of that is giving people full access to that money, because we're in a rising market of values. And at some point that's not going to continue. So now then we're going to face another issue of declining values. People are tapped out on home equity credit lines. And then, you know, that's another issue that we face. So I can agree with the fact of, you know, giving them complete access to it, but maybe putting some limitations on how much they can use on any given time. But I think the larger institutions might be misleading you when they're saying we don't offer credit cards to home equity credit lines, but they still can give you access through online means.
Thanks, Representative. And Representative brings up a good point that I was going to bring up as well. And that is you can electronically transfer funds if you bank at the same institution. And then you have the option of using your regular debit card from your checking account instead of that other card. So my question for you is, isn't this more of a psychological argument on your part rather than a technical or a legal one, given that there's ways to easily already access the money? The way I think of it as we frame this, we could go back and forth all day. I really think it comes down to sort of a psychological, distinction. Because if I can click on my phone and transfer money that I've already been approved for on my home equity line to my checking account, it's just a different piece of plastic. So then where does the distinction really lie? Isn't it all psychological?
It's possible. It's possible, but certainly that's a big piece of it. I don't actually have the bill in front of me. And so I guess I was going to take a quick look and see what the exact wording of the statute is. I don't have that in my head. But I mean, there's certainly there may be a point to that. I mean, technology has changed, and that may have an impact on what you can do and in what ways you can do it. So I can try and I would say I would need to get back to you with a little more thought on that question.
Anyone else? See none. Thank you, Rafi, for your
Thank you
testimony.
very
too.
much.
Okay. Up next, John Erlinghauser. Welcome, John.
First time testifying wearing the cheaters, so I'm officially an AARP member now after 20 years. Chairman Doucette, Chairman Miller, Ranking Member Delnicki, and members of the committee. My name is John Erlinghauser. I'm the Senior Associate State Director for Advocacy and Community Outreach for AARP in Connecticut. And AARP is a nonpartisan social mission organization with a membership of people 50 plus that is nearly 38 million nationwide. This is going well because I can see what I'm reading for a change. And approximately 600,000 here in Connecticut. AARP supports livable communities for all ages, aging in place initiatives, and financial opportunity and resiliency for everyone as they work in the age and retire. We're here before the General Assembly every year on a multitude of bills and that support these issues. We're here actually today to testify in favor of two bills: Senate Bill 1088, an act concerning financial exploitation of senior citizens, and House Bill 6681, the Dodd-Frank bill that the Attorney General testified in favor of. I'm not going to read my full testimony. I will say on the Dodd-Frank bill, we fully support the piece of legislation. AARP has been a strong supporter of Dodd-Frank, and we believe the Attorney General should have all the tools available to him and be able to enforce the regulations here in Connecticut. As somebody who was stuck picking up a check from somebody who had a People's Bank debit card one Friday and wasn't able to be used, I can certainly say I'm sympathetic to the folks that went through that whole process. As far as the financial exploitation bill, I do want to thank the committee for raising it. We've worked closely with the Banks Commission and Department of Banking, and the Banks Association over the last several years. This was first actually worked on and introduced in 2017. My colleague, who now works as an undersecretary at OPM, Claudio Gualteri, worked on this legislation back in 2017. Fortunately for him in the state, he's a lawyer. I am not. But what I will say is that we did bring this legislation. It did come up again last year at the behest of the banks, and we did have some concerns. AARP worked proactively with the committee, the Commissioner of Banks, and other stakeholders to kind of iron out the differences. So this was a process that begun on this current version of the bill last year. And we worked through most of the differences. I know there are still some issues that some organizations have, allegedly minor issues. I will just say that we do support the bill in its current form. Any substantive changes our folks in Washington would have to review to ensure that it does what it's intended to do. We do ask for one minor change ourselves, and that is that rather than using the term senior citizens, if we could use the term vulnerable adults. I will say, particularly to Senator Miller, Senate Bill 10, which is another bill that is a caucus priority for the Senate, Democrats, does use the term in the title vulnerable adults, which we would prefer rather than senior citizens. And I will just say a lot of our volunteers who are here today are members, if they could just give a wave, of the Fraud Watch Network. So this is a big issue and topic for them. They're out on the front lines, of which I'm not. Our volunteers are the ones that are on the front lines, looking out for vulnerable adults across the state, along with our work with the Elder Justice Coalition that the trooper was speaking about earlier. So I'll do my best to try to answer any questions that there might be. I don't know that I'll be able to answer them, but certainly I'll do my best.
Thank you, John. And I want to thank you and your team for the work that you do to protect the seniors. And I know last year when this bill was brought before the committee, you had some concerns and we decided as chairs that we needed to hold the bill until all partners could get together and come to some type of agreement. So I'm glad to see that that's happened. And I want to thank your advocates that are here today. Thank you so much for the work that you've done and
They do
the
the
work
real
that you do and bringing issues to our attention. And I remember one of the first issues was for me was the telephone
Yes, ma'am.
and them getting rid of eliminating landlines. So again, I thank you very, very much for your advocacy, and you're up here all the time doing session. So again, thank you, John. Are there questions from the committee? None? All right,
Oh,
thank you,
I got
John,
off
for your
easy.
testimony.
Thank you, folks.
Sorry. Next, we have Attorney Ed Lang.
Good afternoon. My name is Edward Lang. I'm an attorney in Middlefield, Connecticut. I am the past president of the Connecticut chapter of the National Academy of Elder Law Attorneys. I am a member of the executive committee of the Connecticut Bar Association Elder Law section. I'd like to thank the banking department and this committee for allowing us all to work together to bring this bill back today, which is a significant improvement and enhancement over what we've seen before. And we at Connecticut NALA are totally in support of the idea of moving forward and putting protections in place for the benefit of our senior citizens. Same time, we recognize that not all of us over age 60 are going to be exploited. Not all of us over age 60 are really comfortable saying, it's okay, bank, if you have people who suspect that we're not doing things right, that you're going to freeze our accounts. So we are encouraging all of the parties who are involved in this process to work together to make some enhancements to what's been proposed so far. Specifically, we are concerned about having a trusted contact. We can talk about a number of cases in which bank employees have identified situations in which they believe that exploitation or fraud is occurring. They've talked to the particular customer. The customer doesn't acknowledge it, doesn't recognize it, can't deal with it, and they don't have anyone they can speak to. So we are strongly encouraging that the financial institutions in Connecticut make available a trusted contact form, that it be mandatory that they offer that. We are now seeing too many cases where bankers are saying, you know, we don't have anybody we can talk to. Add your daughter as a joint owner on this account so we can talk to her. In many cases, that is totally disrupting a family's financial plan. The daughter then is the joint owner and entitled to that entire account upon the death of the parent. And I don't think the banks really want to be in the business of offering estate planning advice. The second thing that we're seeing and that we're very concerned about is that as some of our elder citizens become ill, require long-term care, that they are beginning the process of applying for Medicaid benefits. Under Medicaid, an individual is not eligible unless if they have assets of more than $1,600. If a person goes into a bank holding a power of attorney and attempts to transfer funds from the institutionalized individual to that person's spouse or to that person's child or to a trust, that person is not eligible if the bank puts a freeze on the account and says, while we're determining whether or not there's something going on here, we won't make that transfer. The Department of Social Services has no flexibility. If the account says you have $10,000, you are not eligible for Medicaid benefits. So we are asking you to include a provision similar to what we have now in the statutes for life insurance. Just, and if I may just finish up this thought. If a financial institution places a hold on an account, the funds are considered inaccessible for the purposes of Medicaid eligibility. Doesn't mean the funds won't be used to pay down the person's expenses once they're released, but it will not prevent the person from being eligible. And if they're denied that benefit, then family could be paying a nursing home cost of $16,000 a month during the period that this fund is being held and being investigated, and while waiting for the probate court to issue an order to release it. So a lot more I would love to be able to speak about, but I know my time is up and I'll be happy to answer any questions.
Thank you, Attorney Lang. Are there questions from the committee? Representative Doucette.
Thank you, Madam Chair, and thank you, Attorney Lang. Appreciate your contribution to the conversation on this. The trusted person, you had some suggestions as to how to revise the trusted contact provision of the bill. Could you expound on that?
The language that we proposed, first of all, takes out the term may. Currently, the bill says a bank may, or a financial institution may ask for a trusted contact. We're suggesting that we simply change that to say shall ask a person if they would like to designate a trusted contact. It doesn't mandate that someone provide a trusted contact, but it does mandate that the institution offer the person the opportunity to have a trusted contact.
Okay.
And we've offered some language to try and keep it relatively simple, that the trusted contact merely needs to provide their name, their contact information. It's not the same thing as creating an investigation of the trusted person.
Okay. And then to the point you were making about the DSS and Medicaid asset test. Thank you for the point that, did you say that life insurance proceeds cannot be used in the in terms of available funds, and that is not something that is preempted by federal law, or is that's a state law provision that
the current problem that we were having is that people would have life insurance policies with cash values. The cash value would be considered an asset that would place a person over the asset level. And very often families were contacting insurance companies and saying, we need to cash out the policy, but the insurance companies were delaying distributing the funds. So during the period that they were waiting for the funds to be distributed, the individual was considered to be ineligible for Medicaid benefits. We now have statute section 17B-261, which specifically says, to the extent permissible under federal law, an institutionalized individual shall not be determined ineligible for Medicaid benefits solely on the basis of the cash value of the life insurance policy. So I think we could do the same thing with this law to say that solely because of funds that are held pursuant to the right under 1088.
That's good. That's helpful. Thank you. Last question about the probate court procedures as they're currently outlined in the bill. What are your thoughts on those? Do you think as a practitioner that the probate court would be able to react quickly enough to a case where maybe there's a question about a transaction and the bank's not sure how to proceed, do you think the probate court can mediate such an issue quickly enough?
I would love to react like the detective did earlier and say, maybe we should ask the probate court. But realistically, in my experience, and I do a lot of probate work, there are some courts that are able to move quickly. There are some courts that are not able to move quickly at all. I can tell you 2 cases that I have now where we submitted estate tax returns in December and have not yet received the probate court fee, which normally comes from some courts within 2 days, and others are just saying we're too overwhelmed, we can't do it. It's better than nothing, but it's still a problem.
Yeah, that is a bit of a concern of mine, but I guess that's alleviated by the fact that I think that procedure would be invoked very rarely. I've got to think that under the other provisions of the bill, we've outlined the 7-day hold and everything else that goes along with that, or the additional 7-day hold, that by that point, I would suspect that we'd be able to determine if there's, any financial malfeasance happening, and that the whole issue would be resolved. So I think it would be very rare that we'd have to invoke that procedure. So, but I do concur with your assessment of that.
And I apologize if I may be just a little bit aggressive and ask for one extra moment to address the one other issue that we have, is that we suggest that whenever a financial institution places a hold on an account, that the financial institution must then report that information to the banking department. That is in the statutes in a number of other states, and it would allow the banking department then to know what's going on, to monitor how successful this particular proposal is, and would allow us to move forward with knowledge rather than trying to guess. So, and I know that's a burden on the banking department, but we would hope we'd be able to include that. So thank you very much.
No, that's a good point too. I appreciate that. Thank you, Madam Chair.
Thank you. Attorney Lang, I have a question. I know last year's legislation that you were part of crafting the legislation, the bill that was brought before us. Were you a part of this particular bill that's before us today?
The answer is yes. And I have to say that Matt Smith in particular has done a real yeoman's job and should be commended for bringing the parties together. There were certain things, the ones I'm addressing today, are things we had not been able to obtain the agreement of all parties. And it was, and I won't say everyone agreed, but a number of the parties agreed that the next step is to bring these issues to the committee for further discussion.
Okay, so, and I take pause with that because normally that was the problem last year.
Yes.
Okay, that you couldn't come to a consensus. And so I see we're back at the same place this year.
And I have to go a little bit further and say a lot of the issues we had have been addressed. Enough to the point where I'm not going to stand here and say I oppose this bill. And I think it's a good start. I don't think we always expect perfection the first year, but I think there's enough for us to keep working on. And I'm hoping that during the legislative process over the next few days and weeks, maybe we can work with the interested parties to come to agreement.
So, and I want to say this publicly, that when I'm concerned when a group of partners sit down at the table and try to come to a consensus, and then one person or a individuals that didn't get everything they wanted out of that partnership, they bring it to the committee to make known what their concerns are in hopes that that can change the bill. And I'm just going to say that publicly because I see that done time and time again. And the whole purpose of sitting down to craft a bill is so that individuals, everyone can walk away from the table with something that you could live with. And I'm just saddened that we're back at this juncture again. That the elder law attorneys again did not get everything they wanted, because that's why I'm be honest with you, that's why we held it up last year, because we wanted the partners to come to the table and come to a general consensus. And so I'm quite disappointed that we weren't able to accomplish that this year. Thank you.
Thank you. And I hear exactly what you're saying, and I don't mean to be disrespectful to anyone, not just this committee, but any of the other interested parties. But in the course of this process, we've come a long way. So that's why you're not hearing us saying we're opposing the bill. We did have meetings where we agreed that we were going to disagree on certain subjects. And rather than try and embarrass anyone by pointing out who could or couldn't agree, our takeaway was this was the next step. I understand what you're saying, and I'm not looking to make it any more difficult. But thank you.
Thank you, Attorney Lang. Are there any questions from the committee members? No? Thank you for joining us today. Next up is Jeff Jenkins.
Good afternoon, Senator Miller, Representative Doucette, and members of the committee. My name is Jeff Gentis. I am an attorney working at Connecticut Fair Housing Center, and I co-supervise a clinic at Yale. I'm here on 4 different bills. I have testimony scattered about, but there's House Bill 6681. That's the Attorney General's bill that he spoke about earlier. Senate Bill 1084. That's the CHAPA home ownership program bill. 6570, which is about a bank merger ombudsman at the department, and 6571 concerning tax lien assignments. Thanks for this opportunity. We strongly support all these bills. Just quickly to summarize the testimony that we have, down payments are the major issue in having people qualify for homes, not so much their income. So programs that support down payment assistance are really what's needed to move the needle on home ownership. For the sake of the bank mergers, we just have an additional suggestion that the ombudsman monitor these things called community benefit commitments that are often negotiated as part of winning regulatory approval. We know M&T's acquisition of Peoples is probably what drove this bill, but there's a few others where key banks acquiring First Niagara and Webster buying Sterling had some issues around fulfilling these community benefit commitments. In other words, addressing the fact that branches close and that certain services may no longer be available to communities that need it. So we think that could fall within what the ombudsman could monitor. And then the last part is 6571, the tax lien bill. So, there's a lot of testimony. It's the same as in the past, where tax collectors want the ability to do something that we just oppose, which is essentially turn their communities and their residents into financial instruments and to sell off tax liens to third-party buyers. It's coming from, the places that are relying on it are places that I just don't think are well managed. And I think the tax liens are like the symptom for a lot of these communities. It's, a place like West Haven has relied heavily on tax liens. Danbury says, if you take this away from us, then we'll stop selling these tax liens. I think that's great. And all it is here in this case is just lowering the rate from 18 down to 12. And so with that, I thank you for this opportunity, and happy to answer any questions you may have.
Are there questions from the committee? Representative Doucette.
Thank you, Madam Chair. Thank you, Jeff, for being with us. If you could touch on your work, I know at the clinic, we and the bill numbers escaping me, or the Public Act numbers escaping me. We passed a bill that we worked together on a couple of years ago, and it's made it put some guardrails, for lack of a better term, on the tax lien assignment process. But I think what we're addressing here in this bill is sort of something that was left out of that. So could you talk about what's happening in terms of enforcement of that bill that we passed a couple of years ago, and why these additional provisions in this bill are needed for the assignment process?
Sure. So the bill as of that went into effect October 21, thanks to, I mean, it was this committee's work on that area. And I can't remember if it was 21-143, 21-44, one of those two. But it was that put some basic things in. For instance, you know, when you call the tax lien buyers, they're required to give you a statement of what's owed. They're required to have a contact person, you know, things that just were never in place, and that most municipalities that had done the tax lien process weren't bothering to ask for, and were reflective of the complaints that we were getting from our clients and intakes. And, you know, some of the work that's being done, I can tell you that we filed a class action against one of the larger tax lien buyers for abuse of both what they were charging in inflated fees. And even if you point out to them this is inflated, they still would not remove them. And then charging extra padded servicing fees, as if, you know, you get to pay for our ability to hire a company to service your tax liens, which is just excessive. And of course, you don't get those fees from your tax collector. Your tax collector does not charge you tax fees, but, you know, somehow they think that, you know, now that it's been sold off, that they can start larding on these extra fees. So that's relatively fresh, and we're in the early stages. I think I'm going to serve some discovery today or tomorrow on that. And, you know, depending on how far that case goes, we'll get a sense of one aspect of the abuse that's been happening. And we're doing it, you know, the named plaintiff is actually a Danbury homeowner. And a lot of the issues that we saw were coming out of a lot of the clients that we had were Danbury based. In terms of this bill, I think what it would do is, I mean, there's a few things happening. I mean, if you just start with the 18%, is the 18% an appropriate rate to charge taxpayers when they're behind on their taxes? And, you know, for the first, you know, from mid 60s till 1982, the rate steadily went up as sort of the prevailing rate of interest. Notion being, well, we don't want people to, you know, stick money in a savings account and make off better in a savings account than they would by paying their taxes. So I get why the tax rate's higher. It's just never come down since. So, you know, there's been proposals in the building to do, you know, to lower the overall rate from 18 down to 12, even 8. I've heard in, you know, the last several years. What this would do is, you know, you still have a phenomenal investment for these tax lien buyers. And it's one reason that, you know, that these companies have gladly taken up the cities who wanted to sell these off. They take them up on it because they get a secured investment ahead of the banks, ahead of any other lender, and they get it at 18%. And just saying, listen, that's an awfully good investment that most people aren't getting right now in their returns, and, you know, even good years in the stock market. So how about you take 12% instead? And if that causes fewer of these liens to be sold, great. And if that causes towns to say, maybe we need to be the ones who are handling our own tax collection, that's also great. And I think, and I know this is an idea championed by Representative Delnicki. I think that's, you know, part of the thinking is just to make these less attractive. And still 12% as a secured investment is awfully good. And it's money that, you know, I think as a legislature, you intended the towns to get that revenue. And for them to sell it off just for the promise of, oh, if you pay us, the fact, rather than us wait a year to collect the taxes plus the interest, we'll just sell it off now and get those funds now and spend them now. We just don't think that's a great practice. And I mean, and it's in line with the notion of, like, it'd be great to, you know, phase this process out altogether, but it'd be one step towards that.
Thank you, Madam Chair.
Thank you. Are there questions from the committee? I have a question for you, Jeff. So in that scenario that you just gave us, could someone conceivably lose their home?
Oh, sure. Yeah, no, we were representing people in foreclosure, facing foreclosure jail, foreclosure sales, foreclosure judgments. And the thing is that when, if you miss a year of taxes and they sell it off to the lien holder just sits back and waits for your equity to be stripped and just sits back and keeps earning that money. And they actually wait on the foreclosure until it hits a certain number, and then they'll proceed and start with the collection. And still when they know they're going to get that money out of a foreclosure sale. So, yeah, these folks come to us and it's usually been, the tax lien holder has usually been sitting on it for years. So.
Well, thank you for your testimony.
All right, thank you.
So there aren't any more questions. Thank you,
All right,
Jack.
no problem.
Next, we have John Deloria. Deloria, yes.
Diorio, Madam Chair.
I am so
apologize.
sorry,
It's a-
sir.
I've been dealing with it forever, so don't worry about it. It's a font issue. So I'm here today to talk about 6681 in opposition. I recognize and appreciate and admire this body's commitment to consumer protection, and I admire it in our Attorney General as well. This particular policy is just a bit misguided, and there may be ways to fix it, but as it currently reads, there are a few problems. The first problem is it clearly violates state policy as communicated by this committee when Dodd-Frank was put in motion here under 36A 677C. It clearly and unambiguously states that it is the policy of this state to avoid duplication between the federal government and the government of this state in the administration and enforcement of statutes which are designed, This is the actual implementation of Dodd-Frank by this committee. And I think that we should avoid that. Second, the Attorney General's presentation focused on enforcement, which he acknowledges Dodd-Frank gives him enforcement rights explicitly as part of the bill, but that's not what the Attorney General is seeking in this bill. He's seeking supervisory rights. And supervisory rights are very, very different. And Dodd-Frank explicitly dictates supervisory rights within the bill. And I think you might have some constitutional issues, some supremacy issues with the Attorney General getting supervisory authority over entities that are already supervised by the Federal Reserve, the FDIC, the Consumer Protection Bureau. I'm forgetting one or two, frankly. And even within Connecticut itself, the Department of Consumer Protection clearly has the authorities to issue subpoenas, administer oaths, conduct hearings. The supervisory portion that is being sought in this bill, from my perspective, already exists within Connecticut law. So if the authority already exists within Connecticut law, what the Attorney General is looking to do is clearly adverse to Connecticut policy as is stated in statute. It just doesn't seem to make much sense as it's currently designed. There is one last thing that I'd like to ask, if I could have permission of the chair to add, and that is if you do decide to move forward with this, under the supervisory provisions within Dodd-Frank, 1024B2, to be specific, requires that the supervision be tailored based on the size and risk of the institution. So what we're looking at doing right now is implementing
Excuse me,
this
sir, I
long-term.
thought you were summing up. I thought it was going to be brief.
Well, if you do pass this, please accommodate 1024B2 of Dodd-Frank and make sure that smaller entities are not subjected to such aggressive and unreasonable supervision provisions that aren't allowed under Dodd-Frank.
Thank you for your testimony, sir. Are there questions from the committee? Representative Dusecki.
Thank you, Madam Chair. Thank you, Mr. Diorio.
You're welcome.
I'm going to let you finish that thought on 1024B2. I'd have to take a look at that, but explain that to me again. And I guess, you know, I wonder too, because other states have adopted similar provisions, and that's why this came to us. Again, I don't have a 50-state survey in front of me, but there are other attorney generals who have the power specifically that are being, proposed in this bill. So what is that provision again? And are you saying that those states that do have that authority currently are running afoul of that?
I'm not familiar with a state that does have this authority. So I would have to look into that and get back to you, because I don't necessarily agree with that premise. But the particular section of Dodd-Frank that I'm talking about that I think is critical if you guys are going to give the Attorney General this power is 1024B2. And what it says is the Bureau shall exercise its authority under paragraph 1, its supervisory authority, in a manner designed to ensure that such exercise with respect to persons described in subsection A1, which are smaller entities, is based on assessment by the Bureau of the risks posed to consumers in the relevant product markets and geographic markets, and taking into consideration as applicable the asset size of the covered person, the volume of transactions, the risk to consumers, the extent to which institutions are subject to oversight by state authorities for consumer protection. Guys, CUPPA covers this. If you want to put a bunch of heat on M&T, which I don't endorse, I happen to be a satisfied customer, but the Department of Consumer Protection can already do it. And last, any other factors that the Bureau determines to be relevant to a class of covered persons. So if you do think that it's wise to give the Attorney General these powers, please take into account institution size, exempt smaller institutions. You know, there was a mortgage banker who testified earlier today, right? If you're that company and you receive a large subpoena from an attorney general, that can be a crushing event. It's not like entities like that have the resources to deal with such events, and they're already covered by other provisions of law and other regulatory forces. So it's duplicative.
Yeah, I guess I don't necessarily agree with, I mean, first, that the provision you read to us is pretty generic. And second, you know, the CUTPA example, I mean, that's a private right of action. So somebody has to sue to enforce that. It's under the consumer protection, you know, statutes, and that the DCP has some authority to, you know, investigate and provide notice and be a party to that action. But, you know, it's not exactly the same. But, you know, it does raise the point. I mean, you've been before this committee before, and during that time, you've been involved in litigation with the state, with the Department of Banking. And so, you know, this is not the forum to litigate those issues. Okay. But you currently still have litigation pending, correct, with the Attorney General's office on the other side. Is that correct?
There is litigation pending. Judge Cordani will be issuing his decision very soon, and that case is in no way related to this testimony. This testimony is about Dodd-Frank. My experience with Dodd-Frank is seasoned and is connected directly to the person that the name is built, the bill is named after. Congressman Frank and I are pretty tight, and I know what their intention was. And I don't think that 1024B2 is ambiguous at all. It is designed, the Congress's intent was to ensure that smaller entities had protections from these multiple sources of supervision, which is exactly what we're trying to accomplish here. And as for DCP, representative, the Attorney General brings suits under our consumer protection laws all the time. They're currently suing Reynolds over their recycling bags, which is a joint suit between DCP and the Attorney General's office. If there are consumer harms, which appear to be a very small, minute number at this point, related to the M&T merger, the Attorney General has every right through DCP, in cooperation with DCP, to pursue those claims.
And you bring up the federal, I mean, you also have pending litigation on the federal level, correct? To the CFPB, which was created by Dodd-Frank.
Yeah, that's just about,
is-
that's just about over. That's pretty much resolved. It's in the
Okay.
papering process.
But again, and you said it, I just wanted for you to clarify for us that this is, your testimony is made as an individual, as someone with knowledge of the marketplace, and not as part of your litigation, again, with the Attorney General or any other federal or state entity.
It's
That's
not
your
at all
feelings.
related. Those will be resolved by courts and you'll all get the results.
Right. Okay. All right. Thank you.
You're welcome.
Any other questions? Seeing none. Thank you, Mr. Diorio.
Thank you.
Thank you for your patience. I know you were signed up at our original hearing and in the room ready to go, and
My pleasure. Glad we got it done.
Yeah, me too.
Enjoy your day.
Okay. Next, we have Connecticut Bankers Association, Art Corey and Tom Mangello.
Well, good afternoon, everyone. It's a pleasure to be here today, Madam Chair, Chairman Doucette, Representative Hoxa, and members of the committee. I'm Tom Mangello with the Connecticut Bankers Association. I'm the president and CEO over there. We represent all the banks across the state of Connecticut, from the largest money center bank to the smallest community bank. Joining me today is Art Corey. He's our vice president and general counsel over at the CBA and has a wealth of experience with regards to representing banks, and also all things legal when it comes to banking, especially on the deposit side of the equation. We're here to testify on a number of different bills. We'll try to keep it as brief as possible. However, I did want to point out that we have submitted written testimony on a variety of different bills before the committee today, and you'll find those obviously online, and we also have paper copies for those folks who like paper copies as well. I'll be talking first about House Bill 6691. That is what we affectionately call the HELOC card bill. And thank you for raising this bill this year, as you did last year as well. So briefly, this would allow customers of state chartered banks to access their equity line of credit by using a credit card or a debit card. Currently, as you know, and you heard from previous testimony, that state chartered banks can't offer card access due to state statute. But we disagree, by the way, with Rafi Podolsky, that federal banks can offer this and do. We've got several examples I'll get into in just a couple of seconds here, and easily findable if you actually Google it online. Actually, many more profit offerings online as far as the Visa Access Card, as it's called. This is the second year we've tried to raise this, or we have raised this concept, thanks to you. Last year it passed out of this committee, passed the House, and made it to the Senate calendar late in the session, but unfortunately didn't pass in time before the session ended. As I mentioned, this would bring state law for the 36 state chartered banks and 27 state chartered credit unions into what we call product parity, which means that they would have the same ability to offer this card as do their federal counterparts. Why is it important? Because state chartered financial institutions don't want to be limited on the products and the services that they offer. They can't compete with their federal counterparts because, well, they can't compete with their federal counterparts if they don't have the same product offerings. They can also easily switch to a federal charter. It's called charter choice. Exists out there, and a state chartered institution could easily switch over to an OCC chartered institution. Representative Delnicki, just to go into a couple of more details here, he alluded that customers who, bank with state chartered community banks can easily find and switch to a federally chartered institution, and that's the truth. They can easily find it. I mean, I'm probably going to wind up going to a federally chartered institution to essentially get my next home equity line of credit, so I know that I have that easy access by virtue of a Visa Access Card. It does put state chartered banks and credit unions at a competitive disadvantage by potentially losing their existing customers, And more importantly, not getting this next generation, younger generation of new customers to bank with them. Younger customers don't want a checking account associated with it. They want easy access. When you open up a checking account right now, the first thing you get along with that is you get a debit card. You get easy access to your dollars. Why shouldn't that be the same for a home equity line of credit? Some examples of, federal institutions that are doing it: Navy Federal Credit Union, Western Connecticut Federal Credit Union, TD Bank, US Bank, PNC Bank. They all offer HELOC cards, easily findable within 5 minutes, just going online. And as far as preemption goes, we totally disagree with RAPI. It is federally preempted. The legislature can pass all the laws they want if they're clearly preempted by federal statute. For federal national banks, it is. Now, particularly with regards to offering products and pricing, that is absolutely clear. But I've run out of time as far as that goes. We've got several other bills to talk about, but certainly with regards to the HELOC bill, we'd be happy to answer any questions.
Art, did you want to finish?
Thank you, Madam Chair. And Chairman Doucette, Representative Delnicki, and Representative Hoxton, members of the committee. I'd like to testify on a few bills. The first is Senate Bill 1087, which would align the limits found in Connecticut law for state charter banks on their lending and investment activities. This law would simply align those sections of the law with the laws that apply to federal banks and their investment and lending limits. And this has to do with the equity capital definition that we've talked to you about and how it applies to those limits. So this would essentially bring state charter banks into competitive parity with their federal counterparts. The second bill is 1034, which would make a few changes to the low cost account bill and the deposit account bill that were passed into law last session. These changes will address a few unintended consequences that were identified since passage of those laws and would relieve some of our state charter banks of the regulatory burdens of those unintended consequences. Finally, I'd like to express our concerns with House Bill 6681. This is the Attorney General Investigative Subpoena Bill, as it is currently drafted. The bill would authorize the Connecticut AG to issue investigative subpoenas to banks when the AG has reason to believe there's a violation of certain consumer protection laws. A potential consequence of this bill would be to sidestep the authority given to state and federal banking regulators. As this committee knows, banks are subject to numerous consumer protection laws and are examined by regulators for compliance with those laws on a regular basis. There are a few industries that are as highly regulated as banks. This bill has potential to go against the decades-old practice and understanding that banking regulators are in the best position to regulate the activities of banks, protect consumers, and enforce state law. With this bill, state charter banks could find themselves in an unfair situation where they may be stuck between two enforcement agencies, the Department of Banking, for instance, and the Attorney General's office, that may not agree with each other on an enforcement investigation or action, or how the bank is regulated, or even how it does business. We believe that the traditional regulatory and enforcement authority that the Department of Banking currently utilizes should be preserved. Since federally chartered banks would be much less affected by this bill, the bill also runs the risk of making our Connecticut state charter less appealing in comparison to the federal charter. It's our understanding that the Department of Banking and the Attorney General's office are in discussions regarding this bill about these very concerns that we've expressed. And we're hopeful that a resolution that's acceptable to those two parties and the Connecticut Bankers Association can be reached this session. For the above reasons, we respectfully ask the committee to consider changes to House Bill 6681, and if those can't be agreed upon, to hold the bill.
Thank you. Are there questions from the committee? Representative Delnicki.
Thank you, Madam Chair, and good to see you folks from Connecticut Bankers Association here today. Art, you spoke to the issue of the Dodd-Frank. How do you square that with the issues that we had with M&T and the fact that they were an out-of-state chartered bank and really we didn't have a lot of power nor authority over them?
So, we don't want this legislation, we don't think this legislation is about just one bank or one point in time. It's about the Attorney General seeking, looking for additional authority that we think, again, currently and appropriately resides with the Department of Banking. So in answer to the question generally, however, again, we think that we'd like to see this legislation find a way, the parties find a way so that, the Department of Banking, any other state Department of Banking, the federal regulators, I guess I'll just say drive the vote on these investigations and these matters, because they're the ones in the best position to understand what's happening with the bank and to understand the products, services, activities that are involved with consumers, and for instance, a merger that they're in the best position to understand those and lead those investigations, I'll say.
So is it safe to say that you folks being regulated as state chartered banks by the banking department, already there's oversight on you folks, but the folks that are federally chartered or chartered in another state, that's a totally different animal and should be dealt with separately or differently?
So federally chartered banks, you're right, are much less regulated, including by the Dodd-Frank Act and what the Attorney General can do under the Dodd-Frank Act with respect to federally chartered institutions, much more limited. Out of state state chartered banks, there are laws in the state of Connecticut that apply to those institutions, and the Department of Banking does have some enforcement authority. I guess I'll describe it pursuant to those particular laws in the banking laws, but they also have their own departments of banking. They also have federal regulators. Oftentimes they have three regulators: a Department of Banking, the FDIC, the insurer, and then if they have a holding company, which most of these banks do, by the Federal Reserve. So you've got quite a few layers of federal regulators that do for a business consumer protection, including unfair and deceptive acts and practices that were mentioned earlier regarding CUTPA. So again, we think that's the best channel for such a highly regulated industry to have these investigations and issues dealt with.
Well, thank you for your answers to the questions there, and thank you, Madam Chair.
Thank you. Representative Hawks.
Thank you very much, Madam Chair. Welcome, gentlemen, Mr. Corey and Mr. Mangello. So my question is for either one of you could answer it, but it was something that Mr. Mangello said in regards to the how there's some banks right now in Connecticut, whether federally chartered, state chartered, whatever, that currently have these types of cards, referring to the bill about debit cards, credit cards, access cards, whatever you want to call them, that are connected to one's home equity line of credit. And also kind of, speaking a little bit to my colleague, Representative Vanoskovich, who's not here right now, but that, he brought up the concept of, nowadays people have access to their accounts on their, through their phones in the form of online banking and things like that. And it can easily transfer money from a, home equity line of credit to a checking account and, access those funds through their debit card. So in effect, there's already ways around it, whether there's cards specifically issued to access those HELOC funds or not, there's ways around it. So my question to you is this. So in a sense, it kind of does function like a credit card, but from your experience in the world of banking, would you say that a home equity line of credit interest rate is more or less than a conventional credit card, than a conventional credit card's interest rate?
That's a great question, and you're absolutely right. I mean, a conventional credit card is going to be extremely high in comparison to a home equity line of credit. I think it was Representative Vanoskovich mentioned before, home equity lines of credit were down around the mid-3 rate before, obviously inflation and the Fed Reserve increasing the rates repeatedly, and that will continue, obviously, but it's still significantly less expensive And it does give you the ability to have easy access to the wealth that you have built up in your house, which in most cases is that's the primary asset that many people have over years of basically essentially paying that loan down, paying principal off.
Yeah, absolutely. Thank you, Tom. Yeah, I mean, I appreciate that answer, and from my experience, that's been the case as well. And you know, this isn't to target or eh, not consider the viewpoints of the gentleman that was there before you that had a differing view on this particular bill. I understand where he's coming from, and kind of trying to protect the consumer in that regard. But I just think that it's kind of a moot point because, like I said, there's ways to go around it. And at the end of the day, your home equity line of credit interest rate is less than that of a conventional credit card. I know some credit cards offer 0% interest and things like that temporarily, but usually they're pretty, no matter how good your credit is, they're still at a pretty high interest rate. So yeah, no, I thank you for answering that question. And I think that, kind of clears it up as far as making that distinction between what is really, kind of the more, higher interest and riskier product to use. So yeah, thank you very much for that.
You're welcome. And if I could add, let's face it, the home equity line of credit is not just limited to use for, home improvements. The home equity line of credit can be used for all kinds of different things. You only get the tax deduction for obviously home improvements that you've done on that. Some people use it for education. There's a number of different ways that you can do it. However, most people are very responsible in the usage of that. They're not going to jeopardize their house that they, as I indicated, spent years doing, paying for. So because of that, it's just a very low cost, easy way for homeowners to essentially access the wealth that they've built up over the years. But thank you for that question.
Thank you, sir. And that's all I have, Chair Doucette and Chair Miller.
Thank you. Representative Doucette.
Thank you, Madam Chair. Guys, while we have you up there, I had a couple of quick things. One, continuing on the point on the card access. My friend Rafi and I probably feel differently. We've discussed this over the last couple of years on that bill conceptually, or as I phrased it earlier, sort of psychologically. But the point about having a limit, okay. Number one, would you support that to say that no draw or no on that line using a debit card could be made for less than $1,500? And then the second part of that question is, I do tend to agree. Sitting here listening to it, and we know we did a deep dive on this last year as well, but I do tend to agree with Rafi's assertion that under 49(4)(a), I guess is the statute, that's a mortgage statute, not a banking regulation, that arguably in the same way the foreclosure mediation program applies to all types of chartered financial institutions, that this would also apply. And I know, Art, we've had many of these conversations as well, where I start going down that road and then you offer a differing opinion. So there's two questions in there. One, about the preemption, which I think you've answered, but two, let's say we did pass a limit. One, do you support it? And would that not be preempted as well?
Well, thanks for both those questions. I'll defer obviously the legal questions over to the counselor. With regards to whether or not there should be a limit, I mean, we're always of the opinion that that should be an individual bank decision as to what it is. I think typically what you see is that banks will impose some type of a minimum draw, if you will, on the home equity line of credit. But once again, sometimes you'll wind up doing a perfect example. If I get a bunch of sheetrock, whatever, I need to go back to the store, whatever. So how do you actually do that, right? Which is why in some cases, obviously, it would be more quite frankly, convenient. That's what we're talking about, convenient access to one's, home dollars. So I would have to say, generally, we prefer not to have things in statute, which restricts the ability of individual banks to essentially determine what's appropriate for their customers. However, that is certainly something that we can bring back to our membership and explore that with them. So I do appreciate that question.
Thank you very much, Chairman Doucette, for the question. So on the preemption issue. And I've spent a lot of my career looking at preemption issues. And this will actually bring me back to a point in time 20 years ago, where I had hair and I was working on preemption issues. So I don't think it has to be a banking statute for either the National Bank Act or the Federal Credit Union Act for federal credit unions to preempt a state law. It's really any law that interferes with a federally chartered institution's ability to design and operate their products that could be preempted. And 49(2)(c), I think, is the kind of law that interferes with a national bank's ability to, and a federal credit union's ability to design the products the way they'd like to design it. And the story I mentioned about 21 years ago now, was when I was a lawyer back then, I asked the federal regulator for federal credit unions whether this particular statute was preempted by the Federal Credit Union Act, and they responded positively that it was, that they thought it was preempted because, again, it interfered with the federal credit union's ability. I think that's why we see, for instance, Western Connecticut Federal Credit Union in the western part of the state, obviously, that offers this card probably because of that preemption letter that was obtained also many years ago.
Okay, thank you. I thought maybe you're refreshing my memory. We have discussed that credit union memo. One other hopefully quick question, shifting gears on 1088, the financial exploitation of senior citizens. Thank you again for your work as part of that group. We've heard from the Mr. Lang some suggestions to that. And I'm not sure if you've had a chance to look at those, but particularly there's the sort of mandating of offering the opportunity to add that trusted person designated contact, number one. And then number two, there's a suggestion that we touched on just briefly about training for financial institutions, particularly as it relates to the use of powers of attorney. I wonder if you could comment on those.
Sure, be happy to, and thank you. On the trusted person, many times I think, as has been explained earlier today, that happens already where someone will come in, a customer will say, hey, I'd like to make sure that that this is, my son, whatever the case would be, or a neighbor, especially when you're talking about a senior citizen who may be by themselves, don't have children, or their children are obviously on the other side of the country, which happens quite a bit. So I don't think that's really an issue. The membership is obviously looking at moving ahead with this type of an approach to essentially immediately stop elder fraud as much as possible. Once again, we do it already. Mandating it, I guess that's okay. Once again, mandates are mandates. But I think that's happening now to essentially be able to use the tools in this toolbox that the bill lays out, and to essentially say, okay, I have to have a trusted person listed in order to be able to use this law. That's perfectly acceptable. However, there's one rub on this, and that is privacy. So you might recall when the IRS and the president basically came out with an IRS reporting proposal, and I think there were 66,000 letters, if not more, which were submitted to the IRS and down to Congress about why this is an invasion of privacy. So to mandate that we would go and ask all our elderly customers, all our senior customers, or a group that we identified, number one, how do you identify it? I think it was Representative Delnicki who had indicated, well, is it 60? Is it 58? Is it 62? How do you basically decide, oh, I'm going to ask this person if they have a trusted advisor? It gets a little squirrely as far as how you would do that. And you're obviously not going to do it to everyone. And then you say, well, you're a senior citizen. Well, maybe they're not a senior citizen. Then you get into the privacy issue with regards to their own account. They don't like to be asked. I mean, quite frankly, customers don't like to be asked, hey, would you like to have somebody else on your account? They like their privacy, right? So there are some issues associated with it. But, if that's something which is absolutely necessary to move this bill forward at that point, we can certainly bring it back to our membership and see if they're okay with it. Hopefully that answered your question on that.
And the training.
Sure. On the POA, now, bank employees, customer-facing bank employees get training on POAs all the time. Quite frankly, it's one of the most litigious areas, which certainly Art can talk to. He gets questions about this still on a regular basis. Litigious from the standpoint that it may be misused. POAs are now required to be accepted at all banks unless there is a concern about verification of the identity of that person and the validity of a power of attorney. So because of that, we do training on a regular basis. I think, as was mentioned, we're currently doing training now, as was mandated, I believe, by this committee maybe 3 years ago, on elderly exploitation. So we go through courses. Department of Banking has them. I believe Department of Social Services through PSE has them as well, protective services for the elderly. But training is what we do on a regular basis. Once again, we're not fans of mandates, but to move this important bill forward, we would be willing to essentially go back to our membership and ask them if they would be okay with a mandate for training purposes. Now, with that said, Art, did you have anything to add about your experiences with power of attorneys and how they can be problematic for banks?
I'll just say that, this banks do a lot of power of attorney training. I do a lot of power of attorney training actually through our association and a couple of other associations. So I think, that's fine. But this, elder financial exploitation is kind of I know it when I see it sort of thing. And banks are front line staff at branches are extremely good at identifying these things. I having done this in private practice, representing banks with situations where there's a financial exploitation taking place or suspected. I've never had a situation where somebody called me and said, well, we're not quite sure. It's kind of a, on the line sort of thing. They're always asking me because they know it's happening and what can they do? What can they legally do? So while the training is great, it's these branch personnel and their intuition, sometimes more than that is able to allow them to detect this, but the training is good too.
So just back to the training for just a second. So we do it all the time. That's what the association does. We do a huge amount of training for our banks. We put together collective programs. There's absolutely no question that if this bill were to pass, we would put together training to do just that, to make sure that everybody was on the same page with regards to how this bill works, how the power of attorneys work, and how it may interact with this. If it's okay with you, Madam Chair, I would like to mention that Mr. Lang had mentioned that there's a freeze on the account when this bill is used. I wanted to respectfully correct him on that. This is a transaction freeze. It is not an account freeze. That's a critical difference. And because of that, it's one transaction, and say it's a $10,000 cash withdrawal, which, a customer is going to put into a brown paper bag and deliver it to somebody outside. That's a transaction freeze. Their account is still available for regular business. It's just that that transaction alone is not allowed to be processed. The other thing that's critical is it is temporary as far as the freeze goes. So we might be able to get a hold of a family member or a trusted designee, if you will. It's a 7 business day hold, temporary hold on that account. If it does look like it's fraudulent, then that could be extended for a longer period of time, especially if you have to have law enforcement involved or protective services, whatever the case may be. But that was an important clarification I wanted to make, and thank you for letting me make it.
Thank you. Thank you, Madam Chair.
Representative Delnicki. I'm sorry, sir. Did you want to speak?
I'll take a follow.
Okay. I'm sorry. Representative Paolello.
Thank you, Madam Chair. Thank you, Art and Tom. Just to follow up, Art, around 6681, I had started to question or brought the question to the Attorney General's attention during his testimony around having an investigation occurring with the Department of Banking. Can you just kind of talk about, with these new investigative powers, the ability to conduct these investigations with chartered banks, how that may work with other attorney generals in other states, or is it just where the Department of Banking's investigation continues and is concluded, and that's the only one that occurs? Is that your experience, or can you just elaborate on that a little bit?
Yeah, I'm sorry. Yeah, so I think what you'd find in looking at the various other states' laws is kind of a potpourri of approaches, if you will. and especially in terms of the investigative subpoena authority that an attorney general would have. I think you'd find some where, you know, it goes through a consumer protection agency or a Department of Banking, what have you. You may find some that where it's a direct subpoena ability. And so, you know, we think that the approach that works best is to always involve the banking regulators. Again, can't emphasize enough the regulatory structure that banks, unlike any other business really, are in. And it's important to have that perspective. And frankly, in our view, those agencies, those regulatory agencies as the lead. And I think what you see in cases where this has happened, these investigations, you get a very good result for both consumers and the banking industry. I just make the point that banking regulators probably have a primary focus of protecting consumers, their deposits, but they also have a duty to protect, in the case of the Department of Banking, the state charter. It's a good thing to have a state charter, we think, and to have a variety of types of institutions available for consumers. And so, you know, part of what they do also is to maybe support is the wrong word, financial institutions, but they bring that balance to know when or how or have the kind of touch on these kinds of matters where you know, they're protecting consumers, but also you know, not doing harm to institutions that they regulate.
Thank you for that answer. Thank you for that insight. I think it's valuable insight, and certainly as this discussion continues, as this bill moves forward, certainly preserving the investigative authority also of the Banking Commission, and as it relates to chartered banks is certainly important here, and certainly we'll continue to follow this. I wanted to go back to 1034, if I could, for a second. In your testimony, you had mentioned around closing accounts with unnecessary account closure statements having to be sent out to customers when they in fact make the move to close the account. It's unsolicited. It's their decision to do that. Can you just clarify your position there?
So, right, the statute, the way it was drafted, could be interpreted to suggest that when a customer goes into a bank or any financial institution and closes their account on their own voluntarily, that that would trigger the requirement to then mail that customer a notice saying you closed your account or your account was closed, and the reason it was closed, because that's what has to be stated in these letters, is the reason. The reason is because you closed it. That would be probably confusing, I think, to customers, and of course unnecessary because the customer knows why they closed it. There are a few other exceptions that we're asking for in that bill. For instance, when an account is sheets to the state. This is where, you know, a customer has not had any contact with the bank or touched their account, no withdrawals, no deposits in 3 years. They've essentially, as the statute calls it, abandoned the account. The institutions are required by law to send notices to the customer that, you know, their account is abandoned, and under law, they're required to send the money to the treasurer's office. And like I said, there are, I think, multiple outreaches typically. And so we think that when that happens, you know, there shouldn't have to be a notice saying after the fact, after all these, you know, prior notices that the account was escheated.
Yeah, if I can push back on the first part, in terms of the unnecessary notices, you know, folks may go into their financial institution for any reason and close out an account. But I certainly don't know if it's tedious or laborious, or those are my words, but an account should if it is closed, there should be a statement reflecting inaction on an account. So I would say that with, and I would hope that there would be, with the closing of a bank account, a checking account, that there would be a monthly statement that just would indicate there that on February 27th, the account was closed, or it would show zero balance because there was activity. And my point being that there had to be an activity that had to take place, whether it was a transfer to another account, whether it was a withdrawal, check written out that closed the account. There was some type of action there that should be recorded and that should be noted on a statement. And that statement should be part of someone's record, to say, hey, there's zero balance here, and this is the reason why we got there, whether it was solicited or unsolicited, or a person closed it or not. We also know that sometimes folks make many financial transactions over the course of a year, and just may need to, be able to know how that account got to zero. So I just don't necessarily agree with the language that was used in your written testimony today, for folks voluntarily asking for their accounts to be closed. Just because they asked for it, that doesn't mean that there shouldn't be a written record there, and that they shouldn't have some closeout, and the money still be within the bank or with the financial institution. It just may be in another account, and they just maybe need to know how that all happened. So I just would leave it there, that I don't see it as unnecessary.
And I'll just add, I think you would, there, as we've had conversations before about statements, there is almost always going to be a statement involved in a deposit account, and there would be a final statement. I suspect, I could ask our bankers in the room, I suspect that the final statement after an account is closed would probably reflect that the account had been closed. So I think that there would be that, I can't think of a case where there wouldn't be, where there would be some statement that would be sent to or available to the customer that should reflect that.
Okay, and maybe that in of itself would take care of the requirement, and then wouldn't place an unnecessary burden or undue burden on the financial institution. So can I just go back to 6681 for a second? I just want to be clear on your position that you're looking at with chartered banks specifically. That Department of Banking should be in the lead. It should be, a normal course of action as it's been testified today. If there are other partners, including the FDIC and other regulatory partners, that should be the lead, and that's the way that those investigations or reviews should take place.
That's right. That's our position, and without, I don't want to put specifics onto that, because I know the department and the Attorney General's office are working and I think having good conversations. We certainly are willing to participate in that conversation. But yeah, at the end of the day, again, we think that the Department of Banking and other regulators should be involved with the Attorney General if there is an issue, and really should be taking the lead on those kinds of activities.
I appreciate it. Thank you. Thank you for your thoughtfulness, and thank you for answering all my questions. Thank you, Madam Chair.
Thank you, Representative. Are there any other questions? Representative Delnicki?
Thank you, Madam Chair. Getting back to the home equity line of credit, and I'm struck by a baseball analogy. You're the home team. Okay. And the federally chartered, other state chartered banks are the visitor. And I'm struck by the fact that you don't get to play by the same rules with the home equity line of credit and the card. Is there any way that you could quantify the effect that it has had on state chartered banks not being able to offer that product? when conceivably a federally chartered or a chartered in another state could offer it?
Great question, Representative Delnicki, and unfortunately, we don't have that data available. That would be very difficult to put together because trying to get that data off of an FDIC call report, which is typically where most bank data comes from, is not broken out that way. So you would actually have to do a survey to out-of-state institutions that probably don't care about completing that survey. However, I will say that there's, tens of thousands, hundreds of thousands of home equity lines of credit out there already, which is fantastic. It's a great product, a very useful product. And because of that, obviously, those all have access to go online and get that card in a relatively short period of time. PNC is a perfect example. They don't have a bank presence here. They don't have a branch in the state of Connecticut. But I could go on and within half an hour, fill out an application and start that whole process of getting a home equity line of credit from a bank which is based in Pennsylvania and does a lot of their business on a nationwide basis online. So it's relatively easy to access that product. And a lot of people are doing it already. There's no question. But to your point, unfortunately, we don't have that data available. I did want to mention one other thing, and I'd like to thank the Department of Banking for taking the lead on the financial exploitation bill. They did that. It's been great working with them and also with AARP. And I think we're making great strides with the Elder Bar Association as well. But thank you for that question.
And let me just follow up on what you were talking about there on the senior issue. I'm a senior citizen. I'm not a challenged adult or whatever they want to refer to it as. And I'm proud of that fact. Are SARS reports ever generated by banks when they see that kind of a transaction occur? And is there ever a follow-up on that SARS report?
I'm going to put that over to our counsel.
So elder financial exploitation is now one of the leading reasons why financial institutions submit suspicious activity reports. And those reports go down to Washington sort of first to the Financial Crimes Enforcement Network. And then they kind of come back to the states, usually to, the U.S. Attorney's Office, if it's a large enough issue, or FBI, local police, even state police. IC3 that the commissioner mentioned earlier is a consortium of these organizations. They might be involved with these as well. So they yes, that's a leading reason why institutions file these reports, and they do result in actions on occasion. I will say that the volume is so high, unfortunately, that not all of them can be addressed, and so it's a prioritization thing for the law enforcement agencies. So a lot of it goes at least unchecked from that perspective, which makes it even more important for banks to be able to be the sort of the first stop of these kinds of activities, crimes.
Well, thank you for the opportunity to ask a couple more questions. I appreciate that, Madam Chair, and thank you, gentlemen, for being here.
Thank you.
Thank you, sir. Are there any other questions from the committee? Seeing none, thank you for joining us.
Thank you.
Thank you, Reverend.
Next, we have Martin Getz, followed by Maria Elena Britt, and then Nicole Beckham.
Good afternoon. Thank you, co-chairs Miller and Doucette and Representative Delnicki and other members of the committee for the opportunity to testify today in support of House Bill 6691, an act concerning credit card access to home equity lines of credit. My name is Martin Geitz. I'm here representing myself. However, my testimony is informed by my 40 years in banking and my new academic role at Central Connecticut State University. I am honored to hold the American Savings Foundation Endowed Chair in Banking and Finance at CCSU, and am an assistant professor in the finance department in the CCSU School of Business. Prior to assuming my current role, I was president and CEO of Simsbury Bank for 15 years until it was acquired by Liberty Bank in 2019. My support for House Bill 6691 is based on my belief that state chartered banks and credit unions in Connecticut should not be at a competitive disadvantage to federally chartered banks and credit unions. It's also based on my interaction with the students in my bank management class at CCSU, as well as my own children. Connecticut state chartered banks are for the most part community banks. Although the deposit market share of state chartered banks has declined over the years due to industry consolidation, state chartered institutions continue to fill a very important role in Connecticut for consumers and small businesses, as well as the communities that they serve. Community banks remain attractive to many Connecticut consumers and businesses for many reasons, including their ability to match the financial technology available from large national banks. House Bill 6691 will level the competitive playing field for Connecticut state chartered banks and credit unions in one area of technology, the ability of consumers to tap their home equity line with a card. Federally chartered banks and credit unions already have the authority to link home equity lines to a card. State chartered institutions deserve the same rights in this area of consumer technology as their federally chartered competitors. Finally, as a father of 3 children in their 30s and a college professor with 28 students between the ages of 20 and 22, I can confirm that the many studies published during the past 15 years documenting the banking preferences of younger consumers are correct. When I asked my class how many had been in a bank branch, only a few raised their hands. Most young people have never set foot in a bank branch. Most open their accounts online, transact all of their banking activity electronically. Many do not even have paper checks, much less know how to fill one out. My children do all of their banking electronically and value the conveniences that it offers. House Bill 6691 is important to ensure that Connecticut's community financial institutions have the same technology tools as federally chartered institutions to attract the next generation of consumers. Thank you again for this opportunity to testify, and I urge the committee to support Connecticut's community financial institutions by voting in favor of House Bill 6691.
Thank you, sir. Are there questions from the committee? Seeing none, thank you for your testimony, sir.
Thank
Have a
you very
nice
much.
day. Next, we have Maria Elena Britt, who's online.
Hi, Maria Elena Britt.
Good afternoon, Matt. Are you muted?
Hi, Senator Pat. It's Maria Elena.
Okay, you're there now.
Yes.
Okay. May begin, madam. There you go. Oh. Elena, why don't are you there? It looks like you're having technological difficulties.
Yes, I've been here the whole time and now all of a sudden my phone is going on and off.
Okay, well, let's try now.
Maybe Nicole can go first.
Okay. Nicole Beckham, you're next.
Okay. Good morning, Madam Chair. I am just here to support the bill being presented, SB 1084. I am currently residing in a building who the developer is a recipient of CHAFA funding. However, it has been disastrous for us as the residents. We have endured just miscommunication, or I should say no communication at all as to how low income tax credit works. This is a new sector for us as residents, as we were formerly a co-op and we're not under any recertification conditions or provisions. And a lot of the paperwork that people have received in the building is not clear, or they're not understanding how it works. We've not met with the owner but one time, that was last September, which he made promises for certain things that would happen, that no one would be displaced. However, that has not been the case for us. Many of us have received phone calls or letters on the 17th of February saying that we had to be out of our units by March 20th. But there's been nothing saying where we're going, if security deposit assistance would be had, packing, moving, whatever. It's just like you have to be out and that's it. We're looking at resources. If we find anything, we'll share them with you. this has definitely caused major alarm in a lot of our residents. And if you look at our demographics of the building we live at, 70% of our residents are senior citizens, 60 and above, with one being a 100-year-old lady who, you know, is living with her daughter, who's also a senior, and it's just really uneasy and unresting to them. We've endured broken elevators. We're still down with one elevator. You know, unlocked doors to the building. It's just a disaster. It just does not look like there are checks and balances once these developers receive funding. So my question, and what I would like to see is more stringent checks and balances, more communication with the residents as to exactly how these programs work. Who in the city of Stamford, in our case, is a contact person for us to go to when we have these concerns and to get answers. We were fighting. We had to take it to News 12 just to have basic respect. And I don't think that decent and safe housing is a luxury. I think that's just the bare minimum and is a right for us and anyone who's living in these properties. So we've just been through a lot. I just really wanted to be a voice for the people who are actually living this nightmare. We you know, some of us don't even know if we really have to be out by the 20th this month. We got the letter and no follow-up. So we are just hanging on and trying to figure out, are we going to be homeless or not? And I'm quite sure that when the developer submitted a plan, there had to be something in there saying that residents would not be displaced. However, it doesn't feel like that. You know, we got these letters and we don't know what's going on. And no one's answering us from the owner of those companies. They just, you know, sweep it under the rug. They have a managing agency, but they don't seem too knowledgeable of what's going on, or I don't know if they don't have a lot of experience, but it's smoking mirrors at this point for us as residents. And needless to say, it's very frustrating, to say the least. So I'm really encouraging that.
Nicole, may I ask you to wrap up?
Okay, so I'm encouraging that a bill be passed with more clear, concise communication in layman's terms for residents and more stringent checks and balances. I'm done.
Thank you, Nicole. Nicole, I have a question to ask. So when the owner purchased the building last year, I believe, it was in March, do you know when your relocations began in the building?
I'm still in my current unit. I believe some people started moving maybe April or May because they bought the building March 30th and April 4th construction started. So I would say somewhere between mid-April to May, people were starting to be relocated.
And so can you tell us what type of rehabilitation is being done to the building? Are they removing walls where you see studs? Is there dust? Are construction workers, parking spaces? What type of inconveniences have the residents been experiencing due to this rehabilitation?
They've gone down to the studs and the units that they have rehabbed. They're taking the building from 89 units to 133 units. So it's like they're building and flying the plane at the same time. We've been kicked out of our parking spaces. The building is extremely dusty, which has been an ongoing concern for us to know, what are we breathing? Is it asbestos or whatever? It's an older building. The building is, I think, in 1970, maybe 4 to 76. So quite sure there's things going on. So we do have those concerns.
So one of the residents told me this summer that you were down, the elevators were down. I know you were having problems with the elevators, but the one elevator that was working was completely down, and seniors had to be, didn't have access to getting their medication because it is a high-rise building. Didn't have access to getting their medication as well as grocery shopping. And it's my understanding that even the city had the fire department at the building to carry seniors up and down their apartments. Can you answer to that, please?
Yes, I can, and that is absolutely correct. And we still to date are down to one elevator that is sporadically working. You know, even despite being told we would have the second one up and running as of November of last year.
And when you met with the owner, were you given your rights as tenant, low-income tax credit residents?
No, we were not.
Nothing in writing?
Nothing in writing.
were the residents allowed to have a meeting with the owner? And I think you said you met him more just once, but there was no other meetings after that?
We did meet with him once. There was a second meeting on January 24th because the residents were trying to have our concerns addressed. However, he was not at that meeting. There were city officials there and some local representatives, but we've not seen him since.
Well, I believe we had a meeting with your local rep, your state rep, Representative Parrish, and the owner was there, and he made certain promises that your elevator would be repaired. The second elevator was going to be up and running by November, Thanksgiving. And then also, can you speak to the heating situation? Can you tell us about the heating situation, please?
Yes, we were previously only paying for electricity and not heat. Then all of a sudden, we hear there was some construction issues with the boiler, or something happened with the boiler due to construction. So we had no heat at the beginning of the heating season. So the owner had space heaters installed in our apartments, which really don't even get hot to the touch, but it's caused a significant increase in our heating and our electric bills. Some people's bills have gone up from $80 to $400 to $670. The owner has offered a deduction on the rent of like $189 if you're in a 2-bedroom apartment. However, there's still a deficit for the resident if your bill is $600. So it's not in our favor at all.
And just one last question. I appreciate you testifying today because I know it's not easy. So one last question regarding rent. You mentioned, the landlord, the owner, giving you a discount. So during this construction, the rehabilitation, and I should say a couple questions. First of all, is any part of the rehabilitation complete?
Not to my knowledge. I was told I would probably have to be relocated until November off-site because they don't have a unit available for me on March 20th. So I'm not sure. We don't know. We haven't seen anything. I don't want to say yes or no, but I'm not sure. It doesn't appear to be that way.
And so none of the units are complete. Has there been a increase in rents, or was there ever a notice to say that the rents were going to be increased?
We did receive a notice where the rents would be increased, I guess, according to a CPI increase, which a lot of residents did not understand. Some residents' rents, I know personally, went from, I want to say $1,700 to $2,400. And it was just like, this is a CPI increase, which is astronomical. And when you don't understand it, it's sticker shock.
And so another part of the bill addresses signage. Was there a sign in the front of the building at all that someone could determine that the building was being funded by CHFA or any other funding agent?
No, it was not. It is now. And I would say that probably happened at the end part of the year or at the top of the year.
All right. Thank you very much, Nicole, for coming here today. Are there any questions from members of the committee? All right, seeing none, Nicole, thank you very much for taking the time to testify on this bill today.
Thank you for having me.
Is Ms. Britt available? Okay, looks like she's been dropped off. What about Karen Robbins?
Yes, I'm here.
Oh, thank you. Hello, Ms. Robbins. Thank you for joining us today.
Hello, thank you for having me. I'm here today to testify in support of raised bill number 1086. And for the past 3 years, I've been in Connecticut Family Court trying to end my marriage and reclaim financial independence after enduring a marriage and post-separation abuse that was defined by coerced debt as a method of financial abuse. It's my hope that my testimony in support of this bill will help the General Assembly pass an effective law that will hold the banking industry and credit agencies accountable and prevent them from furthering the abuse against women like me. In early 2020, I learned my ex had repeatedly stolen and misused my identity for personal financial gain dating back to 2002. With all of my personal information, he fraudulently opened countless credit card accounts for his personal gain, took out mortgages on a house owned solely in my name through forgery, and stole from my children's 529 plans. What I then learned is, as a result of all of these frauds, my credit score had fallen below the minimum needed to access basic capital and loans for such thing as heating, education, healthcare, and transportation. Court stipulations that required my husband to pay the mortgage, credit card payments were to no avail. When they weren't enforced, my credit continued to suffer and my credit score stayed terribly low. I received phone call after phone call and spent hours on the phone with various banks, attorneys, a public relations executive who helped me pro bono to get out of the throes of the banks that were incessant. I still can't get car insurance. I can't lease a car 3 years later. Life insurance policies are 2 to 3 times more expensive because a low credit score is considered risky. And I can't even rent an apartment after I was forced to sell my house that had been mortgaged. So I have to use a friend for the lease that my children and I live in the apartment. Most banks and credit lenders have no vested interest in providing any relief to abuse victims. They just want to get paid. But without good credit, victims of economic spousal abuse, such as coerced debt, have long odds on qualifying for mortgages, loans, employment, sometimes check on it, etc. I hope that proposed Bill 1086 will help restore positive credit scores for any victim who can show veritable documentation of forged instruments and any other evidence showing that an abusive partner had complete control of their financials. I hope the Assembly finally will encourage financial institutions to partner with abuse victims in seeking repayment from the abuser perpetrators themselves, because I, to date, have been released from all but 3 accounts from what was more than 30 accounts that were fraudulently opened. My credit score has still not recovered, and my husband has not been held responsible, though he was found responsible for opening those accounts. Finally, thank you again for having me. Coerced debt can eradicate a survivor's ability to move forward with their lives, provide for their children, and begin the difficult work of restoring emotional and financial independence. And I think the passage of Bill 1086 will significantly improve the odds of victims like me regaining control of their futures. Thank you.
Thank you, Ms. Robbins. I would like to personally say I'm sorry that you've had to endure what you've had to go through, 30 accounts. And I hope that by passing this bill, that we will prevent that from happening, what happened to you happening to another victim, whether it's a female or a male. And I hope things turn around for you, where you are able to stand on your own and lease your apartment based on your credit. So again, I apologize that you had to endure what you've had to endure for the last 3 years. Thank you. Are there any questions from members of the committee? Seeing none, thank you very much, madam.
All right, thank you for having me.
Oh, thank you. Ms. Britt, we're told that you're back online. Yeah.
Hi, I'm here.
We're going to try it
Can
again.
you hear me? Oh, can you hear me?
We can hear you. We can't see you though. There you go.
Sorry, I had to go to the beach because I'm home. I'm actually home because I have an asthma problem, but our building was too noisy, so I had to pick a spot to do the Zoom. Apparently outside of that mistake.
Yeah, that's a bad area too.
I'm trying my best to go somewhere for the past 3 hours where I can get service. Okay, maybe I can get better over here. I'm so sorry.
Okay.
Um,
Yeah, it's kind of difficult to understand you. Can you possibly find another area where you can get some service?
yeah, I'm gonna have to go
And
somewhere
then,
else. I tried my
yeah, well, you could try testimony without testifying without the video.
okay.
All right.
Yep. Okay. Can you hear me good?
That's better. No, that's not working either. So what we'll do.
Okay.
All right, try now.
Okay, I'm so sorry. I'm trying my best to
Okay,
find a
that's
place
good.
where you can hear me. Is this better?
Yep, that's good.
Okay.
That's perfect.
So, okay, so my name is Maria Lena Britt. I'm a resident of Coleman Towers, like Nicole Beckham just said. I am part of the crew that received our notices on February 22nd that we needed to move by March 20th. I then received another letter last Wednesday that was no longer the case. It's very confusing living in this building because we weren't aware during the first part of the sale that it was going to become a market rate building. And so this whole procedure has been just very, very, very confusing. Can you hear me?
Yes, we can hear you.
Oh, okay. So yes, this whole procedure is very it's been very deceiving and very confusing, and we don't get any answers when we look for answers. When we try to approach a city, it's kind of like a bit of a runaround because nobody really knows what to do with us. At this point, we live in complete filth. We keep being told that things will be repaired, things will be cleaned. We haven't had maintenance done in our building since prior to Thanksgiving. Unfortunately, there's so many germs and things like that just hanging in our hallways. We do have a very, very big senior population. We should be able to live in cleanliness, and we shouldn't have to question what our next step is, because we should always be aware. We're all very confused. We don't know if we're moving in the building now. We don't know if we're being put somewhere else. Nobody's answering any questions.
So are you finished, Ms. Britt? I think you're coming in and out again.
Yes, I'm sorry.
What
Can you
bill
hear
are you testifying on, please?
At the Coleman Towers. I'm with CHAPA. I'm into the CHAPA with Nicole Beckham.
Okay, so that's SB 1084?
Correct.
Okay, so I have a couple questions for you. I know you were told that you were displaced, and in full transparency, CHAPA has stepped up to the plate and told the landlord, to the owner or developer in this case, to cease and desist, to rescind the letters that those families received telling them that they have to move. So I want to publicly thank CHAPA for that. And there are some other conditions that the landlord have to adhere to make sure that the families are protected there. But the intentions of this bill before us today is to make sure, you can't do anything about what happened to the families at Coleman Towers, but we can certainly try to make sure that it does not happen to other families in this state in low-income tax credit deals, low-income housing tax credit deals. So when you spoke to the landlord, were you given any documents, the initial meeting, were you given any documents regarding your rights and the program itself?
honestly, if I was, I don't remember. I mean, unfortunately, this happened during coronavirus time, so everything was taken care of on Zoom. As far as a pamphlet, I don't believe I've gotten anything from him. We did have a previous purchaser before him called Jonathan Rose. That deal went through. Then we got Navarino. I cannot find any paperwork from Navarino stating that we gave him our apartment in these conditions. I also have some of my neighbors looking through theirs. They don't believe that they've received anything either.
So you said that you don't remember getting any paperwork from the owner in the beginning. So there were a series of resident meetings to explain how it's going to work and what your rights are and explaining relocation, where they explained the plan to the residents.
No, we were originally given pictures of what the building may look like. We were not given anything as far as our particular relocation as individuals. It was just, we were given basically a floor plan of what the property would, somebody would envision the property to look like in, at the time of completion. We knew nothing about the fact that we were not going to be, given our equivalent apartments in size, or, I'm coming from a 3-bedroom. I was under the impression that I would get another 3-bedroom. I wasn't under the impression that I was going to be given whatever was convenient to give me, whether that be a 2-bedroom or whatever the current owner wants to put us in. It seems to be that we're all being downsized. And that was not discussed prior to this. So this is a shock for all of us.
So the previous person who testified before us stated that the number of apartments were going to increase from like 89 to 130 something.
I believe I read 118, but that potentially, Nicole would definitely know. So I would actually go by her numbers. I would say, I mean, it's incredible because there's no way that a 3-bedroom even remotely half the size of what I have now. So I believe these apartments to be, if they're going to do that amount, I would say that the apartments are going to be 50%, of what they are now.
So one last question. You mentioned something about market rate apartments that you didn't know about those. Can you speak on that a little more for us?
Yes, absolutely. So I was told that my current rent, which was $16.75, was going to be frozen for 7 years. Now, 2 years has gone by since this took place because of Corona, so nothing could happen. So now all of a sudden this is going on. And now I get a phone call because we did market rate or below market rate packets, which I was not under the impression that that was something that we had to qualify for to stay in our home. I thought it was just that we were going to another apartment. We had signed this man over our property. We were then going to be given this deal, and we were going to stay in the same type of unit at the same price. I thought it was basically because we were giving up our title to our property that's why we were getting the deal. I wasn't under the impression that I had to qualify for a market rate apartment. Now, because he feels that I didn't fill out my packet correctly, I was told that my $16.75 will not be that's not on the table any longer, and my 3-bedroom will now be $4,375 a month.
Okay, I'm going to stop you for a moment because it's very difficult to hear, and I just want to catch up for a couple points. So the market rate is my understanding how the program works is that for the tax credit, the low income tax credit, you have to qualify. You don't have to qualify for the market rate. So you had stated earlier that your rent was $1,675. Did I hear that correctly?
Correct, correct.
And so if you move with this market rate, because you did say that you and I spoke, you said you received a letter and that
Yes.
because your child didn't give you a year worth of receipts from Apple Pay, that your rent is now going up to what?
$4,375 a month.
Wait, I can't even get the numbers out of my mouth.
$375
a month. And is that the same size apartment, or is that when they decide to downsize you? Because you also mentioned that there was going to be a downsize because you have two children of the same sex.
If I go to a 2-bedroom and agree to let them downsize me, it will be $3,475. But if I choose the 3-bedroom, it will be $4,375, I believe.
And this is all under the low income housing tax credit program. That is affordable housing to increase your rent from $1,675 to $3,000 plus or $4,000 plus dollars. Since you do not qualify for that program.
Correct. So right now I have two options, either take the 3-bedroom and just really struggle, or be homeless.
So, and as I mentioned to the previous person who testified, resident, Chaffa has said that they've issued a notice to the owner to cease and desist, to rescind those letters that the residents were given. And there were some other conditions. And so I hope that comforts you all. And I apologize to you. You know, I've done it before, but I want to apologize that you've had to endure what you've had to endure. And I want to thank you for your role, the role you played in making sure that the seniors were taken care of during this process as well.
Yes, thank you.
Are there questions from the committee? Seeing none, thank you so much for joining us today. And I really do appreciate you telling your story. I think it's important for the committee to know. Thank you.
Thank you.
Next, we have Scott Rosenberg.
Thank you, Representative Miller. My name is Scott and members of the committee. My name is Scott Rosenberg. I'm an elder law attorney practicing in New Haven, and I am the treasurer of the elder law section of the Connecticut Bar Association. I'm testifying today in support of Raised Bill 1088 as it pertains to exploitation holds by financial institutions. Elder exploitation is a massively underappreciated problem. It costs Connecticut seniors hundreds of millions of dollars a year. More importantly, they are also highly likely to have concurrent abuse or neglect. And even when they don't, exploited seniors require more medical care and die more prematurely than their unexploited counterparts. That in turn causes them to have an unnecessary and premature reliance on public benefits in many cases. Last session, I spoke against this concept on behalf of the CBA because it did not meaningfully address the roughly 65% of exploitation cases that involve family members, or to a lesser extent, other closely related parties who can simply resume their efforts after a brief fraud hold under this prior bill expires. I echo the sentiments, though, of my colleague Ed Lang in expressing our appreciation to Matt Smith and his colleagues at the commissioner staff working with us to generate some JF language which resolves these concerns and permits the Bar Association happily to encourage adoption of these important protections. The enhancements over last session, it would include a mandate that will allow that banks allow seniors to have a trusted contact, a non-signatory, on their account, a mandate that that party and others be contacted after initial hold to suss out whether this suspected fraud is accurate. And if a longer hold is warranted, that be of meaningful length with written notice procedures and the filing of a police report, so there is some follow-up. While this language is sufficient to avoid major unintended consequences, We do believe, as does CT Dela, that this is part of an ongoing process that was always going to require some right sizing over time to make sure it is used to maximum effect by banks and other financial institutions who choose to comply and is not unduly burdensome to them. We are encouraged by the Bankers Association's acceptance of the commissioner's training and limited immunity recommendations that remain in this proposal from last year, and we know further work will be needed. We ask the committee then to be mindful that this concept ought to be raised again next year to address such considerations. We also encourage the committee to take some leadership in areas that we think are important, but the executive may not have the capacity to request. First, we think it is essential that some basic information be collected on each hold and aggregated by the commissioner's office. Fundamentally, we need to know whether this law is being used. We need to know if it's being used correctly and effectively. And in the long term, such data will provide a meaningful understanding of the scope of the problem in a crunchable numbers format and an ability to identify red flags and counsel specific financial institutions by the commissioner's office. Lastly, we encourage you to work with your partners in the legislature to onboard protective services for the elderly as the preferred follow-through agency on these cases where elder fraud is initially subject to a financial hold and seems to be confirmed by the initial inquiry of the financial institution. Protective Services for the Elderly needs additional funding to do this, but they are an important agency and they are explicitly targeted to stopping the underlying problem of getting a senior sound financial management, a conservator if they are incapacitated, and stopping that fraud. Not only is that an incredibly important moral thing to do, but by stopping the bleeding quickly, limiting the loss of funds, enabling a professional conservator to potentially recoup funds, we divert the need for potential public benefits down the road, which could be a significant cost savings to the state.
Excuse
I
me,
thank
we
you
need
for
you
the
to wrap
opportunity
up,
to testify, and I'm happy to answer any questions you may have.
Okay, thank you, Scott, for your testimony. Appreciate it. Are there any questions from the committee? Any questions? I do not see any. So thank you, Scott, for your testimony today and for hanging in there with us.
Thank you.
Okay, next we're going to move on to Mike Karen from Caddick Commercial. Hi, Mike.
Good afternoon. Hey, Jason, how are you? Good afternoon, Senator Miller and Representative Doucette and all the members of the committee. My name is Mike Karen. I am a underwriting counsel here at Caddick. I've been in the title insurance industry for over 7 years, and prior to that was in private practice, doing mostly residential real estate for almost a decade. I'm here to testify about House Bill 6680, an act concerning mortgage releases and requiring mortgagees to accept certain forms of payment. This bill makes some minor but meaningful modifications, amendments to existing statutes, particularly Section 49-8 of the general statutes and 49-8 little a of the general statutes. Basically, what this bill would do, the first part of the bill would require the mortgagee to send the mortgage release after payment of the mortgage has been made, or in the event of a partial payment for a partial release, it would require the mortgagee to send that release to the town clerk to be recorded. Currently, the statute requires the mortgagee just to send the release to the borrower. There's no mandate that the release get sent directly to the town clerk. And unfortunately, as a result of this, there's numerous situations in which the mortgage release never gets to the town clerk from the borrower. The borrower doesn't understand the significance of the document they've received from the mortgagee. So they could file it away, they could throw it away. And this doesn't create a problem right away, but when they go to sell the property, and they find when the buyer does a title search some mortgage that they thought they paid or that they paid off, could be 5 years ago, 10 years ago, 20 years ago, it's never been released. And so this creates a problem. It delays closings. Oftentimes it can cause the buyer will not close unless that release has been obtained by the seller, which could take months, weeks, months. Or another alternative is the borrower the borrower slash seller would be required to escrow a substantial amount of money with the buyer's title insurance company, which most of the time there's not enough proceeds from the sale of the property for any escrow to be had. So we believe Section 1 of this bill would address that problem without creating really that much of an undue burden to mortgagees. We did do a survey of about half the states in the country, half the states on the East Coast, 25 states. We found that, I believe it's in my written testimony, but I think about 16 of the 25 states had similar legislation. The other states, I don't know the reason why they didn't have it, if it's just not thought of yet, or it was actually debated and decided it wasn't a good idea. But certainly 16 out of the 25 states in our half of the United States have similar legislation. One comment on the existing language in the proposed bill. It does use the term legal representative of the mortgagee. In other words, it would require the mortgagee to deliver the mortgage to the town clerk, or if requested by the mortgagor or the legal representative of the mortgagor, to send to the mortgagor or the mortgagor's legal representative. We would propose changing the word legal in that phrase to authorized. We just want to make sure that the mortgagee, well, let me back up. A lot of attorneys that represent sellers use third-party vendors to make sure that the releases get recorded. We'll call those release tracking companies. And what usually happens is the seller would sign a document.
Can I ask you to wrap up, please?
Sure, no problem. Honestly, I would just, Jason probably can appreciate this, but what we're looking to do is just change the one where they're legal to authorize. I didn't get a chance to talk about Section 2 of the bill, but I'm happy to take any questions, and I appreciate your time. Thank you.
Thanks, Mike. Yeah, I was going to ask you to comment, if you could, briefly on Section 2, in your experience in the industry with what that's trying to address, and then perhaps you could help in this regard. You may know that the Bankers Association has stated some concern with this, not strong opposition, I wouldn't say, but in terms of what they perceive being a lender's choice. In their case, they're talking about, mostly Connecticut chartered banks in the form of payment that they would accept. And in my experience, most of the Connecticut state charter banks will accept an IOLTA check for a payoff of a mortgage. Wondering if that's also your experience as well, and if any other comments on that Section 2.
Thank you for the question. I certainly can speak to that. Yes, I think the Section 2 which would be a whole new section, would require the payment, a mortgagee to accept a variety of payments for a payoff, including a bank check, a certified check, an attorney's IOLTA check, or a wire. In my experience, as likely has been yours, local Connecticut banks and even some regional banks, this was never an issue. Their payoff letters would routinely make it clear they accept IOLTA checks, or even accept a wire. So I think I can understand why the Bankers Association might feel the need to mount some opposition to this. I think in reality, though, that their clients, if you will, their members are already kind of doing what this bill is sought to do. The issue comes from more of a national perspective, from national lenders trying to, when you have a piece of paper, seller's counsel, and it's telling you, we'll only accept a wire, or we'll only accept a certified check. It creates a bit of an issue for the practitioner to be able to service his client properly, especially in situations where there's, especially over the last few years, where there's just closing after closing after closing, and for an attorney to have to, go to the bank, spend an hour at the bank in the middle of a busy day to get a bank check when he has a perfectly good IOLTA check, which, by the way, is regulated. Obviously, our IOLTA accounts are regulated heavily by different agencies here in Connecticut, it just creates a bit of a problem, which in turn, affects their ability to service your constituents. So that's, I guess, my answer to that question, Jason. Hopefully that.
Thank you. And if you could also touch on your experience with wire fraud in the industry, that being the real intent of that provision, so that the instances where there's an opportunity for wire fraud to occur will be diminished. Could you speak to that a little bit in the industry? What you're seeing in terms of these wire fraud in the cases of a bank payoff request?
Yeah, absolutely. Wire fraud and real estate transaction is rampant. For the last several years, it's been going up and up and up. And we typically, the typical situation what we see is that some perpetrator, some fraudsters intercepted an email chain and changes the payoff for a mortgage, let's say a mortgage payoff. It could be anything though. It could be the wire instructions for the seller proceeds. It could be wiring instructions for other things that need to be paid at closing. But they'll change the instruction and it'll make it look like it's coming directly from that it's a legitimate payoff letter, when in fact the payoff letter has been altered and it's going to the bad person, the fraudster. So clearly, if a check is able to be sent to a real address, made out to a real mortgagee, the chance of fraud in that wire and that money going to someone other than it's supposed to be is significantly lessens. So this bill would I think, in our opinion, would help mitigate the chances of fraud occurring. And when that does occur, I mean, it is similar to some of these other people's testimony on other various aspects of all kinds of situations. When somebody loses hundreds of thousands of dollars because, a fraudster changed wire instructions, I mean, that is just, that's going to ruin them for a long time. They can't always get the money back. There's not really many safeguards in them in place for them to recuperate those losses.
Appreciate that. Thank you. Any other questions? Mike? No? Seeing none. Thank you, Mike. Good to see you. Appreciate you being here.
Thank you, members.
All right. Next on our list is Jack Kelly. I was informed that Jack may not be available right now. Okay, so Jack Kelly. Next, we're going to go then to Sarah Porras, who is with us on Zoom. Hi, Sarah. Welcome.
Hi, thank you. Good afternoon, Senator Miller, Representative Doucette, and the rest of the committee. My name is Sarah Porras. I'm an attorney in West Hartford, and I'm here to oppose the Bill 6691, an act concerning credit card access to home equity lines of credit. I'm an attorney. I've been working for 20 years in the area of consumer protection, and the last 15 or 16 years I've been on my own, working primarily with consumers who have too much credit card debt and homeowners in foreclosure. And I did submit some written testimony. I'm not going to read from it. I would like to address some of the issues raised by the other people testifying for and against this bill. I think there were also some committee questions. For example, one of the questions was how many home equity lines of credit are in foreclosure in Connecticut. And I think that's going to be difficult to determine because you can't tell from the face of a case. It's not coded in differently on the judicial branch, whether it's a second mortgage foreclosure. But I did a little quick research, and the Connecticut Insider back in August 2022 did an article that Connecticut has the third highest is the third highest in the nation for second mortgage foreclosures. I'm sorry, for the amounts of home equity lines of credit in the country, not foreclosures, but we're the third highest, an average of $112,000 in home equity loans, national average being about $84,000. So that's thanks to the Connecticut Insider's August 16th, 2022 article. I have some questions as well. for the people who are supporting the bill, which is what kinds of credit card protections are there going to be for these credit cards? Right now, your typical consumer credit card has a clause, or the practice is, and the banking regulations around the credit cards is that when someone reports fraud, the consumer is only liable for up to $50. And I'm just wondering if the same protection is going to be available if one of these cards falls into the wrong hands or is improperly taken over, or the subject of fraud, online fraud. And what's that homeowner going to do? Is there a up to $50 protection there, or is that homeowner going to lose all of their home equity because the credit card fell out of the wallet, the person didn't know their wallet was stolen or lost or what have you? Okay, that's a big concern, I think, that we need to keep an eye on. To address the question of foreclosures in Connecticut is again, according to the Connecticut Insider's October 14th article, Connecticut is the 10th in foreclosures in the country. So we're the 10th highest per capita for foreclosure in the country. And I think that's a concern. And I'm sure that the home equity lines of credit in foreclosure are considered in that statistic. One of the arguments in support of the bill is that access to your home equity should be easy. And I disagree completely. I think this is the kind of money we should not have easy access to. People already easily access their 401ks and other savings. And by the time they get to me, they don't have any money left. All they have is their home equity. And I think that means that if they're going to retire someday, if they're going to leave a legacy to their children, they need to preserve their home equity, and having quick, easy access to it before it is going to prevent them from seeking legal help for their financial issues before they drain their home equity. And we don't want that. Then they're going to have zero when they come see me. And what can we do then? They won't have a lifetime to earn it all back.
May I ask you to please wrap up?
Certainly. I think that I have a couple of other points to make, but I might be able to make them in response to any questions the committee has. So I'll yield the rest of my time.
Thanks, Sarah. Provided some new information there to think about. Any questions for Sarah? Any questions? I don't see any, but again, I appreciate you bringing perspective and some new information on this for us to think about. Thanks, Sarah.
Thank you.
Okay. Next on my list is Daniel Blinn. Is Daniel Blinn with us online? Nope. Okay. So then we are going to move on to Travis Moore, who I believe is in the Zoom room. Travis Moore.
Good afternoon. Can you hear me?
Yes, we can. You can proceed.
Thank you, Mr. Chair. Good afternoon. My name is Travis Moore. I am General Counsel for the Guaranteed Asset Protection Alliance, otherwise known as the GAP Alliance. I am here today to testify regarding Senate Bill 1033, specifically Section 7, which covers GAP waiver products. The GAP Alliance is a national trade association whose members include insurance companies, administrators, and lenders offering guaranteed asset protection waivers, as well as other vehicle financial protection products. The association was formed in 2006 and has since pursued legislative clarity for the industry, as well as consumer protections and clear regulatory framework for the offering of vehicle financial protection products across the nation. To date, 25 states have some form of the GAPA Model Act in their current legal framework. Connecticut is, however, one of only 9 states that does not have a codified section in relation to how GAP waivers are offered within the state. This bill would add a definition of GAP as well as requirements regarding cancellation. We believe that this is an important addition to the banking laws in the state of Connecticut. We also submitted written testimony as part of this, and we've submitted our Model Act, to the Department of Banking to show language that we think would best benefit consumers in relation to how GAP waiver and financial protection products are offered. The definition that is included in Section 7 of Senate Bill 1033 is largely consistent with the way we define gap waiver in our Model Act. It includes a definition of extended wear and use agreements, which is basically gap coverage for leases. It also includes a definition of what we call gap plus, which is the ability of a gap provider to provide a benefit to a consumer in order to purchase a replacement vehicle in the instance that a vehicle is lost or unrecovered theft. We would also encourage that this committee and the Department of Banking consider additional amendments to this existing framework. That includes to the second section under Section 7, letter B, which are cancellation requirements. As written, this cancellation requirement would make companies liable for a complete refund of the purchase price at any time for a consumer cancellation of a GAP product. Now, a GAP product typically runs the life of a retail installment sales contract. You purchase the loan's for 5 years, the GAP product covers you for that 5 years. Under the terms as written in the statute, that refund would be for the full amount, even if a consumer were to cancel after 3 or 4 years. We believe this is unreasonable and untenable for the industry in terms of the product offered. I will say I was listening when the Department of Banking testified earlier this morning, and they did, I believe the term that was used is that the cancellation requirement and refund requirement was intended to cover whatever is left under the GAP term amount. And to that extent, I think that the intent is consistent with what we would ask in terms of an amendment, that any refund due be paid out based on any unearned portion. Oftentimes in many states that might be, pro rata based upon the term of the GAP. But again, as written, this would require a full refund of the purchase price for cancellation at any time, which is I think, again, I do not think it's the intention, but it's a necessary amendment to make improvements. I have submitted written testimony, which includes a copy of the GAPA Model Act. That Model Act includes additional vehicle financial protection products and a framework which includes many consumer protections, including financial assurances and mandatory disclosures. We would encourage this committee and the Department of Banking to work with the GAP Alliance to come up with amendments that would further expand the way in which consumers are capable of selecting voluntary products to protect their very valuable financial interests in their vehicles.
All right. Thank you, Travis. Thank you. Appreciate it. I was going to ask a question. I'm reviewing your testimony now. I see the whole Model Act, which is great. However, do you have specific amendments? I followed what you said about the wear and use, but do you have specific amendments or a fix to our bill that you would suggest or that you could send us?
Certainly can. Again, we'd encourage, an expansion, but at a minimum, I can provide some amendments to that section B. I think the definition is fine in that first piece under Section 7, but the refund requirement, again, basically the fact that it says that a refund, the provider shall provide the borrower a full refund of the purchase price. And again, I don't think that's the intent. It would be replacing it with something like a pro rata refund, provided no benefit has been paid.
Okay, that makes sense. Thank you. Appreciate it. Any questions? Any other questions for Travis? No? Okay. Seeing none, appreciate you being with us this afternoon. Thank you.
Thank you very much.
Okay, next on the list is Susan Williams. Is Attorney Williams with us? I do not see her. So then we will go to Priscilla Dorsey. Hi, Priscilla. Welcome. Hi, you are on mute. We can see you, but not hear you. There you go.
Good afternoon.
Good afternoon. Thank
you. My name is Priscilla Dorsey, and good afternoon to the panel. I am here to discuss the SB 1084 in regards to Coleman Towers. And I'm up here because I have a 100-year-old grandmother and an 80-year-old mother who lives in the building. I live in the building as well. And as Nicole was saying, that the elevator was down, and when it was down, we had to, my grandmother was celebrating her birthday at the time, and the elevator went down. We had to drive around and wait until the elevator was up and running. And that was in the evening. We got upstairs around, I think, 10 o'clock that night. And also that the conditions of the building, it is horrible. It's dusty. It's unsanitary. It has not been cleaned properly for months. And also our trash chute has been locked for a couple of months, where residents had to take their trash downstairs. At the moment now, if I'm not mistaken, it's back up. But far as that, yes, it's horrible. It's, and once again about my grandmother, she wanted, wanted to go out, and we could not take her out because the elevator has been down, and we scared to take her out because we don't know when it's going to stop working. If there's any questions to this, please let me know. Oh, and also my son was also coming to visit me, and he got stuck in the elevator where it opened up on one of the construction floors, and he had to kick his way out to get it, to kick his way out to get out of the elevator. If there's any questions, I don't want to hold up the panel, but if there's any question, please let me know.
Thank you. Thank you for being here. Thank you for your testimony. Sorry to hear what you're going through. That sounds absolutely miserable. But glad to hear it sounds like you have some longevity in your family. You are blessed to have a 100-year-old grandmother and 80-year-old mother. But thank you for being here with us today. I believe Senator Miller does have a question.
Okay.
Thank you. Hello, Priscilla, and thank you for coming, or being able to testify, being willing to testify. Priscilla, do you think that the families should have been moved out of the building, completely relocated?
Before this started, I truly think everyone should have been relocated.
So what did the relocation plan, what was the relocation plan in the beginning?
Let's see. And when they took over the building, I meant to also add this in, that when they relocated us to different floors, they put me on the 8th floor. They put my mother first on the 5th floor. From the 5th floor, because they decided after they did the first to the 4th floor, that they decided to do the 5th floor as well. So everyone from the 5th floor, and the ones that they moved to the 5th floor, they moved up higher. And my mother had to relocate again, and now she's on the 7th floor with my grandmother.
All right, so let me get this straight. So where did your mother live? What floor did she live on prior to the rehabilitation?
2nd floor.
So they moved her from the 2nd floor to the 5th floor for the
Yes.
relocation. Okay. And then now you said she's on what floor?
The 7th floor.
And how old is your mother again?
My mother is 80, to be exact, 81.
Did they help in the move? What was their role in the move?
Yes, they had movers. They had movers. And they had storage for anyone who needed it.
So your mother was relocated, 81 years old, or maybe 80 at the time, twice in less than a year.
Yes.
And so-
In a couple of months
So where does grandma live?
with my mother.
So your 80-year-old mother, maybe 81-year-old mother, and your 100-year grandmother
Yes.
were relocated twice. Grandmom,
Yes.
I'm sure the grandmom probably had some mobility issues. So she was moved from a lower floor, which was the 2nd floor, to the 7th floor, the 5th floor first, and then the 7th floor.
Yes.
And so another question I have you regarding the building, because I know you said the conditions are really bad, and you've been, how long have you lived in that building, Priscilla?
Let's see, 30. It has to be like 30 something years because I moved here in 1977.
1977. Has that building, so since you've been there, was there any type of rehabilitation since you moved in or before you moved in, do you know of?
They upgraded, well, they being that the balconies were tore down, they put the panels up to make windows, and they upgraded like the laundry rooms, which now we are down to like 6. We had a machine, 2 machines, well, in total 4, because it was stackables. And now we're down to 1 on from the 6th to the 10th floor.
So there were basically 2 or 4 machines on each floor?
Yeah, because it was a washer and dryer. They were stackables. And now we're down to 1.
And how many floors do you have? Originally,
We have from the 6th to the 10th.
from the 6th to the 10th. And so
And hold on, I'm sorry, but on the 6th floor, there's no washer and dryer at all. They removed that.
are people living there?
Yes.
So families doing this rehabilitation, families have gone from a convenience of 1 to living in lower floors, 2 to 4. You said there are 4 wash machine and dryers, stackables on each
Yes.
floor.
2.
A
Yes.
total of how
2
many? Did
each.
you say there's 6 in the building?
That let's see, the 7th, 8th, 9th, and 10th. Well, actually 4.
Oh, so there are 4 in the building. Priscilla, do
yes.
you know how many residents are in the building now? How many apartments are occupied? Would you have
I
information?
think there is maybe 40. It might be 40 or less.
Were you a recipient of one of the letters that the owner recently sent to the residents telling them that they had to relocate?
Yes. I am supposed to be moving on the April 3rd to to an efficiency unit.
And how many bedrooms do you live in now?
Right now I'm in a 2.
So you're going to an efficiency, and can you describe to us what that efficiency looks like? Is it a 2-room efficiency or is it just 1 room?
1 room. And to say that I, you know, have a voucher and I'm not sure if I'm supposed to have a 1-bedroom or I'm supposed to go to an efficiency. And another thing is with my mother and my grandmother, they were told that in the beginning that they had to move out.
You mean move out of the building?
Yes, move out of the building because they didn't have a 2-bedroom available for her. And that they also that they couldn't put, but they brought her back down to the office and said that now that her and my mother can move on the 8th into a 1-bedroom unit until a 2 comes available, and it will be at market rate.
Did they tell you what the mom tell you what the market rate is?
No, they didn't say.
So does grandmom require any type of medical equipment?
She has her walker. She, in the bathroom situation, she would need grab bars.
Okay, but there's no
other
wheelchair or anything?
wheelchair when she goes out. Other than that, it's a walker
So
in the household.
well, again, I want to thank you for bringing this to our attention. And I do have one last question.
Mm-hmm.
Do you think the residents were protected in this deal between Chaffa and the developer?
Truly, no.
I should say your rights. Were your rights protected doing this? I'm sorry, what was your answer?
I feel no.
Okay. Well, again, I want to thank you very much for being willing to tell your story. And as I said earlier, I don't know that we're working on trying to help the families at Coleman Towers, but I feel that I have a responsibility to make sure that what Coleman Tower residents have endured, that no other development or residents have to endure what you've endured, because this is supposed to be low-income tax credit, is supposed to be affordable housing. And it's supposed to be someplace where it's decent, safe. It allows its money to allow developers for existing residents or new residents to make housing affordable and to bring upgrades to a property. But I'm just learning with low-income housing tax credits that is not always the case. And so in Stamford, we've had issues with our tax credit properties. And I think that we have to take a closer look at how we hold these owners, developers accountable with the state's dollars. I mean, with these dollars, right? I believe that we have a fiduciary responsibility to protect everyone, and that's especially the residents, because usually those families that live in the developments that qualify for low-income tax credits are families that can't afford a $3,500 rent or $40,000 plus rent.
Yes.
And what this does when you're talking about, because usually it's mixed income. So you have some tax credits, you have some markets to make up for the tax credits. And so those families that they don't qualify for tax credits, they're the ones that they hurt too, because I think that it's important to understand that we live in Fairfield County, which is a very expensive county, and the HUD limits for the tax credits, they're high, they're expensive. And so that rent that was quoted, that is a market rent. And so according to HUD, well, market rent, you can charge anything, but even the tax credit rents, you would think that they're, according to HUD's figures, calculations, they're affordable. But when you look at the people that reside in those units and reside in those areas, it's really not affordable. And we talk about a living wage. We're fighting living wages all the time. So again, I want to thank you, and I deeply apologize to you and all of the residents of what you've had to endure since April of last year. Thank you.
Thank you.
Thank you, Senator Miller. Any other questions for Priscilla? Seeing none, I want to thank you as well, Priscilla. Your senator, I think, summarized pretty succinctly why your testimony is important and why it was important for you to be here with us, to take the time and to come forward. So very much appreciate it, and apologize again for what you're going through there. Thank you.
Thank you.
Okay, we are moving on. Danielle Carter. Danielle Carter is not with us. Lovell Swan appears not to be with us. That brings us to David Klaziski. I'm sorry, I'm sure I butchered that. David Klaziski.
It's Klazewski.
Okay, I wasn't too far off. I apologize.
Nope, very close.
Okay, thank you, David.
All right, so good afternoon, Chairman Doucette, Chairwoman Miller, and other distinguished members of the Banking Committee. My name is David Klazewski. I am the tax collector for the town of Fairfield, as well as the chair of the Connecticut Tax Collectors Association's Legislative Committee. So as an association, we are opposed to raise Bill 6751, which an act concerning the assignment of tax liens, which, as written, it would greatly weaken the extremely important tool of lien assignments, on which municipalities, especially our largest cities, depend on for funding their budgets and restoring delinquent real property to productive use. So this proposed legislation, the part that we're most concerned about is that it cuts the interest rate on delinquent taxes once the lien has been assigned down to 12% from 18%. I just want to illustrate some of the duties of the tax collector before it even gets to a lien assignment, and not all towns utilize lien assignments, but it is incumbent upon the tax collector to do their due diligence on who these investors are. You know, are they reputable? Are they doing a good job? Do they work with other municipalities? And will they be working in the best interest of the town? Many towns also have set criteria before if they do assign liens, they have a set criteria before they even get to this point. So they're not just, blindly just assigning liens. A lot of times towns will have a criteria that says, you must be 3 years delinquent, or you must owe more than $7,000, $10,000. There's some type of criteria before you even get to this point. Statutorily, as tax collectors, we're also required to send multiple notices before a lien ever gets assigned. So if we're going to file a lien, there's an intent to lien notice warning of the filing of the lien. If we're going to do any type of enforcement measure, lien assignment, tax sale, traditional foreclosure, we must send a demand notice that essentially warns the resident of some impending action, such as a lien assignment. So, what I'm trying to say is, by law, we are required to send numerous notices to the taxpayer, so it should not come as any surprise when you get to the point of your lien being assigned. They should be well aware of what's happening, because there has been lots of back and forth communication between resident and tax collector. So with that said, as tax collectors, we're also required to follow the statutes, which are consistent and uniform. It requires us to treat all taxpayers the same. And we believe that we are most effective when the statutes we abide by are consistent and uniform. So this legislation, it creates inconsistency by providing a break to the taxpayer who has their lien assigned by reducing their interest from 18 down to 12, while any other taxpayer that is either delinquent, subject to a traditional foreclosure, or to a tax sale, they're still being charged 18%, not the 12%. So, and I want to reiterate, I know this legislation came up a couple years ago. My predecessor, who has since retired, William Donlin, I'll say the same thing that he said, which is we're not opposed to guardrails when it comes to lien assignments. But we strongly believe that interest should be uniform across the board. as tax collectors, we're not policymakers. We simply charge interest based on what the statutes tell us to. So, you know, we really don't get involved in terms of what the rate should be, but we truly believe that we're most effective when it is uniform and the same across the board for everyone. So as a
Thank you,
collective
David.
group, we respectfully request that you vote against this bill. Thank you for your
Thanks,
time.
David. Appreciate your testimony. Any questions for David? I did actually have one. In Fairfield, why is it, I assume you're speaking on behalf of the association, so maybe
Correct.
this is your experience in
Yes.
Fairfield per se. So if it isn't, then maybe you could speak to generally your understanding of other, you know, tax collectors out there. What goes into the decision as to whether to assign a lien as opposed to using the tax sale or a straight foreclosure?
So I don't do lien assignments myself in Fairfield. I know there's only three, as I mentioned, there's only those three methods that we can do. We can't do anything else other than the three methods of enforcement that you just mentioned. In general, it appears to be the larger cities, and I don't know if it just comes down to preference, what works best for municipalities. Some towns have different collection rates. They need to get to a certain rate each year in order to meet budget. So it may be that the assigning of the liens just works better for them. But it's still, like I was mentioning, it doesn't matter what town you're in, you still have to send intent to lien notices warning that a lien is being filed. You have to send a demand notice warning the taxpayer that some type of enforcement action like foreclosure, lien assignment could occur. So there are guardrails in place at the tax collector's level. And then from what I understand with the recent changes, there's additional guardrails in place when it comes to the investors. And again, we're not opposed to any of those guardrails. What we're opposed to is reducing an interest rate, but only for one facet of our collections. We believe, we're not going to sit here and tell you what interest rate it should be, but we're going to, argue that it should be uniform and the same across the board. We find we're bringing in the revenue most effectively for municipalities when there's no inconsistency. In Fairfield, it shouldn't be that, we're 12%, but Bridgeport is 18%. And then there's confusion as to, do I pay in Fairfield, but if I move to Bridgeport, should I not pay in a certain town because I should not report that I moved for my motor vehicle taxes because my interest rate is lower. So we just believe that, as an association, we're most effective when interest is uniform and the same. And this creates inequity in that, the methods are different, but someone could be 5 years delinquent and be subject to traditional foreclosure, or 5 years delinquent and have their lien assigned, but they're getting a tax break or a break on interest versus the individual that went to traditional foreclosure.
I appreciate that. And I appreciate everything that the tax collectors do. Certainly, I would imagine that all tax collectors are exhausting all, instances and remedies to, and providing notice and all of that. I don't dispute any of that. And I understand what you're saying about the difference in the interest rate. I guess the difference between those different remedies, the tax sale versus the assignment, is that on the assignment, you are basically in the worst instances and the worst actors, you're feeding your taxpayers to some loan sharks. Okay. And we're trying to account for some of those bad practices. As you said, we've put guardrails on that, so hopefully we don't see that happening as much. But but there are a lot of fees, as we heard, sort of phantom fees, additional fees, excessive attorney fees, and all that get tacked onto it. So though it may seem that they're, as you say, getting a break on their on the interest rate, the collections practices are really ramped up, and a lot of extra fees and costs are being put on there. So that's where we're going with this, I think. But no, I appreciate and I also appreciate as well, and I don't expect you to be able to tell us all about this, but the economics of it from the municipality's standpoint, looking at the present value of those that debt, and what it looks like to balance a budget. And I do wonder, and again, I don't expect you to be able to answer this, what that discounted value, the present value of that debt would look like if we reduce the interest rate. I think that's the argument here as to why we shouldn't do it, because it would mean less revenue for the municipality. Again, I don't know what the hard economics of that look, dollars and cents of that look like. I don't know if you can, tell us anything about that.
In terms of if it was across the board reduced?
Yeah, what are we looking at in terms of the value of that debt to the town if we were to do this? I mean, has anybody quantified that in a specific way?
Again, like our association hasn't per se, because it really, it's just, as I mentioned, we're not the policymakers. We just enforce collection based on what we're told within the statutes. If it says 18%, then we enforce 18% a year. I would imagine, finance directors, CCM, mayors and selectmen, they would get involved if it came down to, reducing interest across the board.
And that's what I haven't seen that number yet. So it's, I guess the assertion is that you would be reducing this, debt, this real, revenue driver to the town by, 20%, 30%, 10%, whatever it may be, if we were to reduce that interest rate. I haven't seen that. I know that's probably difficult to ascertain or to get in any specific way.
Yeah, I mean, and I know this is, you've probably heard the saying before, but the 18%, it encourages individuals to prioritize property taxes, pay it timely, not put us on the back burner, so that in turn the on-time taxpayers get a healthy, reasonable mill rate, because obviously the less that gets paid, the higher the mill rate goes up. So this is all to support and encourage on-time payments, and also provide a reasonable mill rate for the on-time taxpayers.
I can appreciate that as well. Any other questions? No? Okay.
And I just wanted one last thing. It's just that, along with the fact that we have to send these notices, I did also mention that, I can't tell you every single town that does these lien assignments, but I can tell you that the majority of them, they're most likely, they're doing their due diligence. They're going to, look into these investors. Sure, there are probably some out there that didn't, and this is probably why we are where we are. But most collectors are going to do their due diligence. They're going to check and see, have these investors done business with other municipalities, speak with their colleagues, ensure that they're working in the best interest of the towns. And, like you mentioned, Representative Doucette, to ensure that set some guidelines so they're not, charging these fees, like you've mentioned. Sort of like do a background check on them, speak to other municipalities. Yeah, I know my predecessor, who spoke on this 2 years ago, that would have been his process, and I believe that would be many of the other collectors' process as well.
I remember Bill Donlin being here when we discussed that bill a couple of years ago, and he was helpful. And I think that bill is ultimately going to be very helpful too.
Yeah, and what he emphasized was we're never against the guardrails. We don't, this is like a last resort. We don't ever want to get to this point, but when we do, like he mentioned in the past, and like I mentioned, we're going to do our due diligence and ensure that the taxpayer is in good hands, that we're not just passing it on to some unknown investor.
Okay. All right. Well, thank you, David. Thank you for joining us and for your patience with us today.
Thank you.
Okay, we are moving on. Steve Rubin. Steve is online with us. Hi,
Good
Steve.
afternoon.
Welcome.
Thank you, Representative Doucette. Nice to see you again. Senator Miller, thank you for having me, and members of the chair. So I'm the current serving president of the Connecticut chapter of elder law attorneys. I am an elder law attorney with offices in Milford, Connecticut, and West Hartford. I also practice in Florida and New York. So I see a lot of issues with elder law, and I'm testifying today regarding financial exploitations of senior, SB 1068. The Connecticut chapter of elder law attorneys, we support any work to try and prevent elder fraud. Financial fraud and abuse impacts our clients on a daily basis, and we see it consistently. We want to do anything in our power to try and prevent as much of it as we can. My personal belief is we have no idea how much fraud is out there impacting seniors right now, because most people don't share when they've been a victim of financial fraud. No matter what age somebody is, I have friends who've been victims of financial fraud and they do not like to admit it to the public because it's embarrassing. So we really don't know how much is out there, but we know financial fraud exists. Our concerns with this bill as currently drafted, though, are what happens in a lot of the situations that impact our clients. Right now, while 7 days, it does not seem business days for locking a transaction may not seem like a long period of time. When it comes to an individual who's applying for Medicaid benefits, that 7-day period of time can be huge. That could be the difference in a $15,000 bill or being able to qualify for benefits and have appropriately prepaid a funeral contract or another expenditure that could appear like financial fraud because of the amount of transactions happening in a short period of time, but are actually just part of a comprehensive Medicaid spend down plan. So we would suggest that adding in a provision that makes any asset that is locked for any period of time regarding this or any transaction that is blocked be inaccessible for public benefit application purposes. We also feel that there should be mandatory reporting requirements based on the thought of financial abuse. Elder Protective Services is the organization that is designed and established in the state to investigate these claims, and they are useful. I've actually had this situation before. Now, my client's account was not locked, but my client had an account at a bank, and the bank was concerned that there was financial fraud going on in his accounts because there was a number of checks being written out for cash. They called Elderly Protective Services, and Elderly Protective Services reached out to my client to have a conversation. We met with Elderly Protective Services. My client was able to explain that he was having drywall put into his home, and his drywaller wanted the checks made out to cash. But that's the exact way that system is supposed to work. Elderly Protective Services is in the right setup to investigate those claims and to look at and see if there's any actual abuse going on. We would suggest that everyone involved in this should be made a mandatory reporter to ensure that those claims are properly investigated. We would also encourage training on the program. And while I saw the testimony earlier that talked about trainings for power of attorney, it felt ripe to bring this up because I had this issue today. I had an appointment this morning at 11 o'clock with a client who came in who had added one child to her bank account. There's a power of attorney. There's other assets and vehicles involved to make payments, but it was suggested by her banker that she do that because it was easier than using the power of attorney. Unfortunately, that now means that that child is the joint owner on the account. And there would be an issue now when that parent passes away. How are their funds going to split up amongst the children? There are 3 children here. How are they going to get the money? Because
Thanks,
it only
Steve.
goes to one.
Your 3 minutes is up. If
Understood.
you can summarize.
In summary, I made some suggestions in my written testimony. I echo the words of Ed Lang and as well as Scott Rosenberg, who testified earlier on this, that we support the concept. We really think that there should be something to protect seniors. We would just like some safeguards added.
Thank you, Steve. Appreciate your involvement with this issue over the years. And we hope you continue to stay involved as this bill makes its way through the building. Any questions for Steve? No. Okay. Seeing none. Thanks again, Steve.
Thank you.
Okay. Moving on. Next, we have Bill Marone. Hi, Bill. Welcome back.
Good afternoon. Good afternoon. And Senator Miller, Representative Doucette, Senator Berthel, and Representative Delnicki, and all the members of the committee. I'm attorney Bill Marone, and I'm president of the Connecticut Creditor Bar Association. And I would just like to offer our general comments on Senate Bill 1086. being towards the end of the agenda in the people offering testimony today, it gave me an opportunity to sit through everybody's testimony, including the riveting testimony that Karen Robbins offered. And I'm sure I will hold on and listen to Megan Scanlon, who's following me, because I reviewed her written testimony on this bill, and I realized that Karen is exactly who the bill is designed to protect. And so my general comments are designed to maybe refine the language and sort of ensure that people that the bill's not designed to protect don't use it as a sword to potentially get out of obligations that they or that are due and owing. So I've made a couple of suggestions. One, I would, if possible, recommend stronger language about the ability of a creditor to pursue the abuser. I would ask that the statute actually specifically allow a cause of action under the statute, which would come equipped with both punitive damages and attorney's fees recoverable by the creditor, so that the abuser cannot in some way benefit from the abuse that they've created economically and sort of get away with it. The second thing that is almost more of a concern would be there's a little bit of bifurcation in the way the two sections work. In the credit reporting agency section, the credit reporting agency has an investigation ability and an ability to determine whether or not that the coercive debt has existed. We would hope that the other section would be able to mirror that as well. And then the next big thing would be, I'm sure the instances will be very rare, but if someone were to try to use this as a debt avoidance scheme, we would like any of the documents submitted as coercive documentation to be offered under the pains and penalty of perjury to deter people from doing that. So those are our comments. I'm happy to take any questions anybody has. We appreciate the work the committee is trying to do in this space, and recognize that true victims should be afforded some levels of protections, and we just want to try to balance the equities. And I know that my time's running short, so I'll take any questions the committee may have on it.
Thank you, Bill. I appreciate you being here today, and I especially appreciate your constructive comments on this. I do think they are pretty reasonable, and like you said, Megan Scanlon's going right after you, so we can sort of get her feedback on it as well, and we can work this all out this afternoon, I'm sure. So appreciate it. Any questions for Bill? No?
Before I cut the line, as a constituent, I think that there's going to be an honorary dinner for my state, my former state senator, Cassano. And I can't speak for my whole town of Glastonbury, but I do thank him for his decades and decades of faithful service, and I hope he enjoys a well-deserved evening.
Yes, thank you. I'm headed there this evening.
A bird told me that, so that's why I made my comments short, and I'll let you stay on schedule.
Yeah, we're doing good on time. I appreciate it. Okay, well, thank you, Bill.
Thank you.
Okay. And with that, the aforementioned Megan Scanlon is with us. Hi, Megan. Good afternoon.
Hi. Good afternoon, Representative Doucette and Chairwoman Miller and the rest of the members of the committee. So I am obviously the CEO of the Connecticut Coalition Against Domestic Violence. I'm here representing 18 of our domestic violence service organizations across the state to urge your support of Senate Bill 1086, which we do believe provides simple solutions to address coerced debt. You obviously heard from a survivor earlier today. So really what we're trying to get at here is exactly her situation. We know that coerced debt can take many forms. We know that an abusive partner may incur debt without the survivor's consent or coercion of the survivor. through threats of harm and putting them in debt and a poor credit score, essentially resulting in them having a harder time advancing themselves economically and independently, and also advancing any other opportunities around education, housing, and employment. So that's really what we're looking to address here. This bill is modeled after California and Maine, who respectively have passed similar bills in their states over the last several years. Maine, I think, was in 2019. And really the proposed definition establishes to us a clear list of documentation that survivors can present to both the consumer collection agencies and credit rating agencies to prove that a debt or portion of debt was incurred as a result of duress, intimidation, threat of force, fraud, or undue influence. So upon receipt of that documentation, the proposed language does make it clear that the agency is not prevented from pursuing collection of the debt from the individual who is found to have incurred that debt, otherwise known as the offender. It does also require credit rating agencies, when presented with the documentation, to remove any reference of that debt from the survivor's credit report. So at its core, we know that this is really about power and control. And so for us, we want to provide options for survivors to be able to take back their power and take back their lives. And we feel like this does move us in the right direction to do that. Employers, landlords, and utility companies make extensive use of credit histories during screenings. So we do want to make sure that we are setting survivors up to succeed, to be able to obtain employment, rental housing, get reliable transportation, be able to afford basic utilities, because we know that it's absolutely almost impossible to do that without a stable living situation. So we represent annually over 40,000 victims that come through our doors. Many report being trapped by years of economic abuse. And we believe that this is a critical step, given the prevalence of the economic abuse that we've seen over the last several years, especially with the pandemic. We do urge passage of this bill and would certainly hope that all of you would support it. And we certainly thank you for your consideration.
Thank you, Megan. Thank you for being here with us today. Thank you for all of your work with the coalition on all of the various issues around domestic violence. I actually heard you on the radio this morning as I was coming in and pulling into the garage. So we see you working hard, and appreciate this bill, and Senator Cohen, I want to recognize for bringing this concept forward. Have you seen the comments offered by Attorney Marone? I think some of them are very reasonable. And particularly, and as I read the bill initially, his suggestion about, just stating that it be under penalty of perjury when offering that documentation of coerced debt seems reasonable. Do you have any thoughts or comments on that?
Yeah, so the California law actually does include the penalty of perjury language. Maine does not appear to include it. I think maybe a compromise is something like under penalty of false statement, or something along those lines, where it's, we're talking about a felony versus misdemeanor, I think, with the language.
Okay, that's a good suggestion as well. Okay, appreciate that. Any other questions for Megan? Senator Miller has one.
Thank you. Hello, Megan, and thank you for being here today, and as well as you and Senator Cohen bringing this to the committee's attention. Megan, I have a question. Do the victims have a problem or difficulty in proving the coercion?
So typically, I would say if they're working through one of our agencies, they work with an adult advocate that can help them get all the documentation that they need. And then certainly, I think one of the things that has been in the other laws that we've referenced is there's like a statement typically from the domestic violence service provider that's working with them as a backup statement to say, so-and-so individual has been working with us on this issue. This is like the steps that we've taken with them. to try to correct and rectify some of the issues that they're having around debts owed or reports to credit agencies. And we certainly would encourage individuals to work and have that affidavit as part of their supporting documentation as well.
Okay. Do you have data that you can share with us?
Yeah, yes, we have national data. So right now we have national data. So we are a member of the National Network to End Domestic Violence. They have national data that shows that about 99% of victims are subject to some sort of economic abuse, coerced debt being a really easy one for offenders to take advantage of their victims with, often without them knowing, because they often take accounts out in their name or credit cards out in their name, or like you obviously heard earlier, specifics around the survivor's individual circumstance. And that is unfortunately pretty common. And often I think we know that financial abuse obviously is part of the abuse and can often start there and then escalate to other serious physical, if not later, lethal forms of abuse. So we do really think that economic justice work is really important to survivors being able to leave, but also just leave safely. So we integrate it into their safety plan. We integrate it into their access to different services so that we're working with them on what their safety plan is, but also how they're going to independently live safely outside of their current situation.
Well, thank you for your comments. And again, thank you for bringing this issue to the committee's attention, because honestly, educated me on something that I never thought of. You hear of the abuse, but the different forms of abuse, but this was one that I never knew existed. And when you think about it, if you're a victim, they victimize you all around, right? If they victimize you in one area, you're a victim.
Yeah, and I think even with the pandemic, it's become more of an issue because of the financial issues around women. There's been a greater economic impact on women, and especially women of color. So this has been a huge issue with individuals seeking to leave a certain situation, feeling like they're tied down by certain acts of their offender. So we really do want to try to give them resources. So I really appreciate this committee even considering this bill.
Thank you. And again, thank you. When you use the word resources, thank you for being a resource for those individuals that have been victims, because it's not just them, it's also the children as well.
Exactly. Yeah. Thank you.
Thank you, Senator. Representative Santos.
Thank you, Mr. Chairman. Hi, Megan.
Hi.
I just have a comment. I just want to thank you for bringing this issue to our attention and echo many of Senator Miller's words. This is talking about domestic violence and all the surrounding issues around it is difficult. And for the folks who are facing this, it's difficult for them to seek help. It's difficult for them to find help. And I recently had the opportunity to read up on some of the work that your coalition is doing. Certainly read your testimony that you submitted. And I just want to commend you for this work, because it's not easy work, it's taxing work, and it's also emotionally draining work. But you are doing magical work for these folks who wouldn't have any other sources of advocates. So I applaud you. I applaud Senator Cohen for bringing this concept up, and I look forward to this committee taking action that has meaning and that can impact these folks in a positive way. So thank you so much for all the work you're doing.
Thank you. And I would just say it's the survivors that sort of should get the big shout out here, because they are, coming to us in their worst moment. So for them to know that, out of this committee, they have legislative champions. We've certainly been really grateful to work really well with Senator Cohen, Senator Miller, and others here. So thank you again.
Yes, thank you.
All right, thanks, Representative. Any other questions? Okay, seeing none. Thank you, Megan, for joining us,
Thank you.
for your patience and being our last speaker on the list today.
It was an honor.
So with that, I do not see anyone else who we skipped over who has resurfaced or anything of that nature. So I will declare this public hearing to be closed. I appreciate everyone's participation and patience with us today. Thank you.